I Hi everybody, good night.
Hi.
Yeah, let me just put my phone on.
Night.
Night, Simon. Night, everybody.
All right, so just a brief intro. Um, because of circumstances beyond all of our control, we have to do this session virtually, but that's a good thing. It's an opportunity. It gives us the opportunity to, get a feel of how this virtual session works. Okay, so for those that are new to Stocks on the Rocks, Stocks on the Rocks is really not just talking about stocks. It's really an event, or let's say a social gathering where people with similar passions come to discuss and kind of flesh out more matters surrounding finance, economics. Boy, sometimes we even go further than that. But I've learned a lot over the past couple months, and I'm sure others have. So let's just join in. So just a few rules. All the attendees have been muted. However, if you have a question from the attendee side, you can send in a chat. You can send in a message through the chat, or I've shared a link on Slido, www.slido.com. You can use the code 1 second. You can use the code G316 and you can submit your questions there. Okay, so for today, what we really wanted to discuss, we didn't want to um, over exaggerate all the other things that we had. So we put out a poll um, asking people what they want to talk about or what they really want to discuss because our time here um, will be limited. So the overwhelmingly favorite topic is opportunities in a crisis. What opportunities are there for us, for businesses, for Jamaica overall? We'll be talking about the different industries that may thrive under, sorry, I can't pronounce that TH, that may thrive, yes, thrive in times of a crisis. Um, and we can talk a bit about value investors. And we have the vice president of Barita. I mean, he can tell his title. He has many hats, but he's overall responsible for all of the money that he put at Barita. So Raman will share his perspective from a portfolio perspective. So he is a professional in the field, and he will speak on this. So just to give an intro before I pass over to Ivy at Ivy Views, the JC has gone down around 29% since the start of the year. Since Jamaica reported its first case, the market has gone down around 14%. Many advisors have said to me from many different brokers across the industry that boy, they have clients coming in and saying, look, sell everything. Sell everything. It doesn't matter what the market price is, just sell it. And I suspect that that's a part of why the market has pulled down like that over the past few weeks. Um, Investors would have been speculating that other investors were also taking gains on stocks that they would have earned those gains on over the past couple months or a year. So as a matter of fact, the market has been coming down since before this corona scare. Um, the COVID or corona has really just exaggerated that decline. And as a matter of fact, if you look even further back, it's been coming down generally since August 2019, which is August of last year. So the first topic that we want to talk about, I want to introduce Wendell Ivy. He's an economist. He's been on all the morning shows talking about this topic, but I have some questions for him, and I'm sure you have some questions for him as well as it pertains to opportunities that may arise. Just quickly, we have a panel here. We have Gillian Jackson, Ashton, Julian Morrison, Proven, Ramon, as I said before, and Trevon Morris. We also have Makeda. So Ivy, I pass
Yeah,
over
I'm
to
here.
you.
Yeah, man, I'm here. So, guys, good night, everyone. Good night. So basically, before the COVID-19, right, I've been looking at, scanning the horizon to see basically what opportunities would actually be there in the future. Because we all know that we are going, our the fourth industrial revolution is emerging, where basically everything is going digital. And we can see signs of that from before COVID-19. So for me, basically, I think that the COVID-19 has basically fast tracked some of the things that as a nation that we should actually be thinking about. So with that now, I've been looking into what kind of opportunities are there or will present themselves in terms of in the digital era. So there is this concept called the gig economy, where it's really like is a short-term kind of flexible arrangement, contractual arrangement that is normally done through like an online platform. So I've been really looking at it, and it is something that I think that we should be having a discussion about to see, because as we look at it, many people will actually lose their jobs due to COVID-19. What will they be doing? What will minimum wage workers, which I think are some of the most vulnerable people of our society, or will they cope? And it's not just about them, because once they stop spending, then start spending collectively, then it will affect all of us who are actually spending, because prices can increase and stuff like that. There's no consumption, which lowers what we call aggregate demand, which might just push our economy in a recession. So I think that this is something that we as a nation should be really looking at. So basically, the gig economy, as I just said, is basically a flexible work arrangement. And many people who work in the gig economy, they believe that it gives them more flexibility in terms of a work-life balance. And I'm sure everyone here today basically would love to have that work-life balance, because many times we're at work and we have some personal stuff to deal with, but because our work is so demanding, we can't do it. So we are here on Monday, and probably Friday comes and we just basically get in the time on Friday to do it, in which we could have done it from Monday, because there's no flexibility. So if I should compare it now with the traditional people, because I've been looking at this study that has been done in America. It has been published in February 2020. So that's like last month. It is really fresh. So I've been looking at some of the things, and I've decided that I want to share it, because the more people we have been talking about something which can allow us to earn an income, the better we are all of our. So basically, traditional workers who work like 9 to 5, it studies basically saying that they prefer why they work. They work because of financial security and the benefits. In comparison to that, now you have the gig worker now values flexibility and a work-life balance. So if you should look at the sectors in which you can actually make some money in the gig economy, you have like recreation, business services, transport, professional or technical services. And one thing that I've realized with this thing is that you as a person, you have to value personal productivity to work in the gig economy, because everything will depend on you. And with personal productivity, you will be charged with basically upgrading your own skill sets. So I just continue. So you have accommodation, food services. Of course, we know about Uber and Airbnb. Those are two basically gig economic type of work, but that is in the American setting mostly. We don't really have a platform here for ourselves. It has not been developed. So I'm thinking that people who work in the tech industry, this is an opportunity for them to really do some work in order to help us as a country move towards going into this digital world. Because for me, basically, for far too long now, as a country, we tend to be too reactive to things. We are not. My thing is that Jamaica, we don't lack innovation. It is just that there is no way there to really facilitate our creativity. And that is something that is basically holding down the knowledge transfer that we should be having. So for example, I know many of us might be driving on the streets and we see a cartman driving a cart. What does that come from? That is really innovation. So, and many other things out there where we see Jamaicans get very creative with, but it does not make any money. Yes, it is all fun and jokes and creative. It has potential, but it is not being facilitated in order to benefit those persons who are being creative and also everybody else in a wider sense. So I'll move on. So basically, as I said before, gig workers tend to be very highly educated because they have to focus on productivity, personal productivity. So you find that people who work in a gigs economy or do gigs, they have very high level of education relative to the traditional workers. And the study has also verified that. So, and you also have more males than females. So in the traditional workplace, you find that 52% of the traditional are female and 48% are male. While when you look at the, yeah, I'm here.
Sorry, so I had a few questions really gig economy. How advanced is the gig economy in Jamaica now? Like,
all right.
What?
So yeah, I was coming to that, man. I was just basically giving an overview.
Okay, sorry. Go on.
Yeah, so I was just giving an overview, man. So then we'll just come down to the Jamaican context. So we have far more males working in the gig economy. So it is 60% to 40%. And then when I look at retirement plans, gig workers tend to save and invest more than traditional workers. Why? It is because that the gig workers normally, they are not really paid, get retirement benefits from the company or whoever they're doing the work for. So they will have to, as I said, come back down to your personal thing and personal productivity. They will have to basically go and save their money for their retirement because no contribution is being made to any employer plan or employer basically putting on a pension for that person. So you find that the gig worker now tends to invest more, save more, and also they put more money in self-funded retirement plans relative to a traditional worker. While the traditional worker, most companies give us our benefits. So now, in the context of Jamaica now, we have many people working in the gig economy, but they don't know that is what they're actually doing. For example, we have a teacher who teaches. She teaches, for example, from 8 to 2 or 8 to 3, but then she might have a Saturday class that she collects different money for. But in the Jamaican setting, it is really informal. So that is to take care of the Jamaican sector, but it is there and people should look more to it to basically supplement income. There are a lot of online courses that can be done and what of things that they can actually get out from it. So now Simon, I can ask.
Yeah, so if I wanted to take advantage so it come off kind of strong, but if I wanted to start some form of business idea which could benefit from the circumstances that we are in, what are some of the things that I can look towards? I know that delivery services is one part of that.
Mm-hmm. So now you have, remember I just mentioned with the teaching now, many people are at home now. So basically like how we're doing this Zoom thing now, they can have many people doing tutoring services by not even leaving their homes. And that comes back to even with the whole, it will also help with the financial inclusion also. Because now you don't have to go meet the person face to face. For those who are not already not into the banking system, because there are many older persons who are still want to go into the bank rather than basically do an online transaction.
All right. So Ivy, we have an interesting question from, well, two questions from Randy Burgess.
Mm-hmm.
So he's asking, how would you assess the state of Jamaica's tech infrastructure preparedness for a surge in the gig economy? So
yeah, that is the thing now. That's why I was saying that I'm looking at it, and I think that I see many apps are being done, but I'm not sure how far are we with that. But I think that for the gig economy, we need, as I mentioned before, that we need the tech people now to really look into this thing. That's why I've been looking at it and trying to have discussion about it so that more people can become aware, and then opportunities will arise from it.
okay, so because from this quarantine thing start, and the guys who this is their first stocks on the rocks, okay, we're very candid and we just really speak here. From this quarantine thing start, my flow internet now work properly.
Yeah.
Everybody there home. I'm not the IT person, but my flow networks, even though they were bad before, I barely have strong enough internet. Right now, my pray say this internet no fall through. So you're saying that, and I guess Randy's saying the same thing, that a part of what we need to do is to develop our tech infrastructure so that it can support not just the gig economy, but the overall economy in general.
This will see a lot of the things, as I was saying before, with the fourth industrial revolution and everything going digital, this COVID-19 has basically fast tracked some of the thinking. So now if you look at working from home, that I guess some people might have been considering it and have been doing it, but not on a large scale. But after this, to me, this is basically like a pilot to test this work from home thing by force, really.
Understand. So basically, we are, as you had said in your introduction, we are backed in a corner, unfortunately, and some things. So, for example, one of the things that I did not know didn't formally exist in a lot of public sector agencies was work from home policies. Yeah. Suddenly, permanent secretaries had to reach out to consultants to draft work from home policies almost overnight.
Exactly.
Just to facilitate that. And we have another question from Randy Burgess. He was saying, let me try to find it. He was asking from a regulatory perspective if there are any regulations specific to gig workers, or would they fall in another tax bracket. I from my perspective, I think the tax bracket that they fall in would just be based on the amount of income that they make, and the amount of income that they not just make, but the amount of income that they report.
Yeah. I would think so too. But as I'm saying, this is something that it can offer some benefit to a lot of people who might be home and they don't have a job to go to. They can learn some courses online and then employ those skills into trying to do something and earning an income. For example, suppose you have a man who, as I said, I like to use the minimum wage people because I guess they are the lowest paid people. So they can go to work from, say, because many of them go to work like from probably about 7 and leave like 6. It's almost all of their day. But at the end of the week, they collect like what, $7,000, $7,200.
Yeah.
They could develop a skills. Because the thing is that I don't think that these persons can't learn. They can learn. It's just that probably many of them grew up in some very poor families, and this is the best that they can do. But there are courses online in which some of the courses they can even do them without getting a certification, but just to learn the skill. I can pay for $25 to get some. I personally do some courses online on EDX. Sometimes $25, 25 US, but the content is really good and it teaches you a lot of stuff. So I'm saying it is all digital world and we need to be having discussion around these things and not just when a crisis come about, we start to shuffle and go into these things and they were there from before.
And I guess this is why we really term this from before opportunities, because as I said,
exactly.
this is forcing us
Yeah.
to actually think about this and not just think about it, because I always assume that there are very smart people in policy making, the government, etc. And I'm sure that they would have thought about these policies, but thinking about the policies is clearly not enough.
Yeah,
You have to
actually
be in a
trying
position
and
where you
doing.
execute the policy. And I think a lot of them, not just from the public sector perspective, but a lot of private sector companies and entrepreneurs are now in a position where they are forced. Ivy, there's another question around, I think this one really surrounds the technological infrastructure. It's an anonymous attendee. They were asking, with the absence of the advanced mobile payment architecture, like Apple Pay, Android Pay, etc., how much do you think that is? How much do you think it is dampening the growth of this gig economy that you're talking about? And has anybody cracked that solution as yet?
I don't in a Jamaican context, no, I don't think so. And I think this thing has potential to be very huge and has significant multiplier effect on our economy because it can significantly allow many people to actually earn incomes that were not there before. And I was looking at this thing and it was saying that yes, children who are in primary school now, about around 60% of them, when they do reach a job market, yeah, they will be working in jobs that don't exist today. So this is the type of thinking that we need to have because that is where the world is going. So the quicker we get there, it will be the better for us. It will actually help.
Sorry, Ivy. I know you had shared that with me personally before, but what are some of those industries that our kids and grandkids will come and see that don't exist at the moment?
No, I'm not sure, but I know it will be something very digital.
Okay.
Very digital.
Somebody from Slido asked, and it comes back to the same. It's the same question over and over again. So yes, we understand, or we are now hearing more about this gig economy. And the gig economy is usually online driven. People can provide professional services online, but a major disadvantage for us as Jamaica, in the Jamaican context, is really our technological infrastructure, and not just the technological infrastructure, but payment infrastructure, right? And even if you fix the payment infrastructure, this person is saying many persons are locked out from official banking due to account opening requirements. So these are usually counted as the most vulnerable in our society that don't have access to the formal financial sector. Let's say the technological infrastructure was okay, right?
Yeah.
And there were payment methods. How can we include, let's say, how can we include somebody that wants to sell goods in the depths of Trelawney in this gig economy if they don't have access to the formal financial sector?
But I guess the whole infrastructure around it would actually have to be developed, and certain laws and legislation will have to be put in place to basically regulate, which would have to kind of factor in some of those people.
Okay, yeah, so we'll have to have supportive policies. But and I don't know if Gillian, sorry, Trevor, go.
Yeah, is it that we actually don't have the infrastructure? Because just based on scrolling Twitter, right? I have seen particularly Miss Douglas Halsall, and I have seen quite a few products that he has shared. So why isn't those products used more? Is it that we haven't adopted them yet? Because they are there. So why aren't we seeing them as, you know, popular payment methods in Jamaica now? What do you think would be the real issue there? Is it us not adapting to the new world, or is it the product not what would I say, friendly to us?
Boy, yeah. So that goes back to the same thing, you know, and it's a issue that also we would call development economists have with really connecting those two segments of the market, and I would say two, including people in the formal space. But Trevor, somebody mentioned something that you just said. What became of all these mobile payment startups that were being backed by big banks? So I guess the much up on NCB because payment platforms are mobile payment platforms such as Quisk from NCB. I know GK had one. These things were supposed to use, and I'm not the tech person, they were supposed to use SMS and a technology that is more widely available to the average Jamaican. And this would have probably included them in what we're talking about. I don't know the progress of that. Matter of fact, I don't see quick advertise again.
Well,
Yeah, from my set up a quiz account, I've not seen anything
can
else
I, yeah,
ever
man,
seen.
can I just add to that a little bit? All
Yeah,
right.
Yeah,
man.
man, Ashdale.
Yeah, man. So some of these online these mobile money transfer and stuff like that, right? Some of these banks have some regulations. They're called KYC. So it's know your customer. So they have to at least understand some basic information about a customer before they can authorize them to actually start conducting business, such as sending money and receiving money. So these KYC compliance, right? These laws, sometimes it involves a customer actually going into the bank and sign up for these services. So them already in the bank, right? So them sign up for these services. They must say, you know, what is the advantage of using a mobile service rather than just do this thing same old like a brick and mortar, for example. So that's why some of these technology, they're often left on the back bench. But it's just that us as millennials most of the time get to actually use this technology, but they don't really last that long. If you understand what I'm saying.
I'll add a point to that.
Okay.
In addition to the KYC requirements, which is one of the two things I wanted to say. So yes, there are KYC requirements for any person who is going to be in the bank system. So it's a regulatory concern for the banks why it's not fully adopted. And it's also, from my understanding, it's also a problem with integration. So being able to use the same kind of payment system across multiple lending institutions would have been something I think that would have been more readily accepted by the population. But the fact that each system is agnostic to one particular institution has also delayed its widespread implementation.
Okay. Correct. So each bank, what Gilly was saying is that each bank is like on a different platform. So NCB uses different payment methods from Scotia. So while it can work within a bank, a cross-bank transfer is a little bit more complicated than that. So that has kind of slowed down the adoption of such technologies.
Okay, understand. I wanted to touch on generally. Hold on, let me see if I get a lot more questions. So, so people are shouting out needs, needs. So if you, so I guess the argument is if you have needs, then a lot of this KYC thing, etc. Not even a lot, all of it wouldn't necessarily be needed because everybody would be on that system. Somebody asks one name quiz. So Quisk is a mobile money platform that NCB had launched. Can I say
Around,
a few years ago?
yeah, around 2, 3 years.
Yeah, man.
Yeah.
About that.
Randy asked again. Yeah, man, we need to assess why Jamaica isn't attractive to new ISPs. Is our so-called liberal tech market really liberated, or have we created an environment that only the current oligopoly can exist
Yes.
in? So I guess Randy is arguing from a competition perspective.
Mhm.
Okay.
Simon, Ramon here.
Yeah, man, Ramon.
If I can comment on that, I mean, yeah, I think that's definitely a part of the challenge. You know, we have a two-player market, and at different points in time, I suppose the capacity of both of the players in the market, you know, is kind of constrained in terms of innovation, etc., given the financial state of both entities. So that, you know, plays a role as well, because I mean the business that they're in is very capital intensive. So if they really don't have, you know, capital available, or if the principals have kind of constrained the amount of capital that they're going to put to work, it's going to play out in the service, or the level of service that we get.
Understood. Yeah. So I mean, boy, there are challenges all about, but here we have industries that should thrive. And the first one that I had, and I know that you guys can chip in on this. So what are the industries that you think, and this will feed into our stock market argument when Raman officially comes to speak. Um, what are the industries that should thrive under these circumstances? And the first one comes to my mind is consumer staples. For those who don't know, consumer staples are, let's call it, the things that you can't do without food, right?
Essential.
Essentials. Right.
Yeah, so the essential stuff, right? So what are the essential those industries? Sorry, somebody was saying that there's an Amber Pay as well. Um, I'm familiar with it, but I haven't heard much about that really being widespread.
I
But
think
yeah,
it's Alliance. Alliance offers the Amber Pay, I think.
okay, Alliance offers that. So wait, and that's Alliance Payment Services. just to clarify. So that's
All right.
Alliance Payment Services through ePay. Yeah, but what are the industries that you guys think could be positively affected in these circumstances?
Simon, Ramon here.
Yeah.
And I think just to add to that in terms of what will be positively affected, right? I think what is important as well is to kind of look at industries that will be a little bit more resilient, or that will
Okay.
recover a bit more sharply post, you know, some level of resolution, you know, in this crisis that we're going through. Because the fact of the matter is, you know, given the nature of the crisis, there are definitely a few narrow sets of companies or industries that will benefit while the crisis is going on. But, you know, given what is playing out in the market, where, you know, you're seeing precipitous falls in values, it may well be a situation where you kind of have to look for companies that will either be, as I said, more resilient and that are being sold down just as much as everything else, or companies that will rebound fairly sharply, you know, once we get to the finish line of this thing.
Okay.
Okay. So what all right, so let's go to the resilient ones first. And I guess here, Ramon, you're talking about companies that may very well be affected now. However, they are most likely to survive any prolonged period of crisis or a period of crisis.
Yeah, so you kind of look at companies that have, I guess, low susceptibility to what's going on, right? Companies that are more conservatively positioned. So, let's take for example, like, something like a Wicton, for argument's sake, where their business is generating energy that's sold to the monopoly power provider in Jamaica. I mean, why should Wicton fall just as much as, say, another company whose business is going to be decimated by what's going on?
Like a tourism company, like a X fund per se.
Correct. Yeah. So, I mean, that's kind of how I would look at it.
Okay, understood. I was recently thinking about retailers such as Fontana, and of course, we're not giving out stock advice here, guys. I know Raman is licensed to do that, but I'm not.
Yeah, yeah. Please understand with disclaimer. Tonight, I am not licensed. I am not giving out any advice.
Oh, yeah, yes. So we're not giving out any stock advice, guys.
Only information. Only information.
Only information. So retailers such as Fontana, we talk about the unlisted one. Come go Price Smart, and the way Price Smart business increase, they must increase the size of the space where the lines turn at the front. Mega Mart as well. Those businesses I suspect will be positively affected. But do you think that the larger financial companies will also be within that band of what you call resilience, Raman, or the resilient companies?
Boy, I mean, it depends, right? Depends on how they're positioned. The financial services groups in Jamaica have become fairly complex over the years, with all of the different acquisitions that have happened and things. So really, it's just a matter of how these companies were positioned coming into the crisis. So I'll give you an example. Let's say, you're invested in a banking group or a group of financial services entities where, the dominant company is in banking, right? And let's say that company, for example, has heavy exposure to the tourism sector or heavy exposure to sectors in general that, are really going to be challenged, going into and coming out of this crisis, depending on how long it lasts. Then you may well see over the course of the next couple of quarters, some level of underperformance related to that. Or let's say, you're invested in a financial services group where, the dominant player is the investment house, and the investment house was very aggressively positioned heading into the crisis. They had a whole lot of risk assets that they were invested in. And as we know, every market, or most markets rather, have been declining, meaning stock markets, certain bond markets have been going down. They would naturally get a hit. So it's kind of harder to peer through the complexity of the groups, and to kind of blanket statement say, financial services may be more or less resilient.
Understood. But then again, I think using that argument, Ramon, it would also depend. So let me just try to see if I understand what you're saying. So you're saying that you can't say that financial companies in general will survive this, because you have to look at each financial company, or it depends on how each financial company was positioned on their own individual balance sheets, for example. So
correct.
It could be safe to say that regardless of the type of company, it also depends on how that company was positioned to manage a crisis, or a possible financial crisis or recession itself.
Very correct. I mean, and to add to, kind of what I said, to give a little bit more direction to my argument, the diversification and the increased complexity that has, happened in the financial services sector over the years has also helped them to be fairly better positioned for a situation like this. So, if there is a downturn in one section of the group, it could be held up by other sections of the groups. So you know, that I think there definitely would be opportunities in financial services, but not all of the companies within the industry naturally have equal resources or, you know, equal levels of risk management, etc. So
Somebody said any company that can survive FinSac can survive this. So I said that that's a clue.
that's a good one.
Yeah, sorry. Somebody said something a while ago.
Yeah, I was saying that, Arlon here. What I was saying is that given that how highly regulated banks are, you would expect that they, more than most industries, would be in a position to weather the storm. But or you expect, given, because a lot of banks and financial institutions go through stress testing of capital adequacy ratios they need to meet. So you expect them to weather the storm, but you should anticipate a significant amount of volatility, given that a lot of them trade in securities, which are, we see, prices have gone down significantly all over the place, as well as the exposures they have in their loans business to sectors, for example, the hotel sector, that's
Okay.
struggling right now. So you might see an increase in the non-performing loans over the next couple of months. But the understanding is that these guys should be prepared for these sort of eventualities. So even if you see, and then they're making significant profits. So don't expect, for example, our NCB to go from 28 billion to a loss. They have a whole heap of room to get to zero. So those are, you should expect some sort of resilience there.
Okay. So and hold on a second, though, or Ireland, don't leave. So just to kind of flesh out what he said a while ago, when he said companies that are prepared for this, you're not necessarily just talking about them supply chain and the customer base, etc. You're really talking about their capital that they have to weather the storm, yeah?
Yeah, no, I'm talking strictly how the balance sheet is set up. You have to have a certain amount of liquid assets ready to be deployed in an emergency to meet withdrawals if your clients decide to say, okay, we want to get out of this. All of that are taken into consideration.
Okay, and I mean, for anybody that wants to see the exposure of these companies, well, we're talking about financial companies now, to different sectors. I believe in their audited statements and the annual reports, they should provide their exposures to different industries. I know that David had shared NCB's exposure on Twitter, but I haven't personally looked at the rest. Okay, okay, understood. So prospects for companies that are less consumer staples, but more consumer discretionary. And you guys can tell me if I'm wrong. So for example, like express catering, right? I wouldn't consider certain products that they sell as staples per se. Am I wrong or right?
Express catering, for I think they, more than most companies listed on the exchange, are likely to feel this COVID pandemic more than most, given that they strictly provide services to people who travel. So, because they own most of the concession stands in the Mobile airport, so you're thinking, okay, if
Yeah.
nobody's flying, the country is locked down, their revenues have essentially gone to zero at this point. So they will feel this hit, but then the turnaround time could be just like that, given that if we open up back our borders and are able to get flights coming in based on the response that the other governments are able to muster to fight this pandemic, they could see a turnaround in a very short period of time.
Understood.
Yeah, man. So Simon,
Mhm.
just to kind of support what Alan said. So, it relates directly to what I was saying before, which is what are the companies that could reasonably see the sharpest rebounds, post this? And I think, Alan has rightfully pointed to Express, where certainly during this time, I mean, I can imagine that their business has slowed materially. But certainly, if things are to get back to some semblance of normalcy, then naturally they're going to see like a sharp rebound.
Okay, understood. Guys, bear with me. I'm trying to juggle the questions on Slido with some questions on YouTube. So David was saying that just to note, Swipe is a collab between Sagicor, Digicel, and another entity. NCB's loan portfolio is 48% personal, but my understanding is that for people that would have taken out personal loans as well, some of that may be affected by a lack of income. However, NCB is one of the banks that would have expressed their willingness to have some forgiveness or push down principal and interest payments for a couple months. David is saying main events is a dark horse, so I guess main events should be materially affected by this crisis. However, coming out of that, as Arlan would have stated, it may be one of the companies that see a sharp resurgence. But we keep on talking about, and I guess Ivy can chip in on this part as well. We keep on talking about, okay, when this happens, etc. One of the questions that I've been getting the most is, when is this nightmare going to end? When can I feel secure or almost secure back in my financial markets? Do we have our finger on the pulse on that one, Ramon or Alan, Ivy?
The COVID-19?
Just that overall, but its impact on the economy and the financial sector potentially.
I think basically it's gonna last a long time, because the economic impact is gonna be very significant, and we have managed to basically contain the virus so far, but as we can see today, it reached 30 cases. So we just have to see how long it takes in terms of flattening that curve. So but it hasn't spiked as yet.
So Ivy, do you think, or are you saying that even if this COVID nightmare were to end in July, August, as Trump has suggested?
Trump?
No, the man is the president, so
Trump had 16,000 new cases today.
Yeah,
I don't think Trump is the right person you want to quote about anything at
all. So multiple sources have said, probably in the late summer. Are you saying, Ivy, that the overall economic impact isn't going to be abrupt? It isn't going to stop abrupt. So it's not like businesses are going to start back and we are going to get back to a period of normalcy right away. Is there something like in that?
It definitely will take some time. It definitely will take some time, but we don't know as yet, because the virus is doing its thing. We can't do anything about it really, because fundamentally many of the firms are okay. It's just the virus and people and the perception of the people.
Yeah.
Go ahead, Ramon.
Yeah, so Simon, so my view is kind of like what was just said a while ago, that the virus is doing its thing. That's really what is happening. So my base case is really for a shorter term recovery. That's my base case, right? But necessarily you have to contemplate, what if, scientists are slow in developing some type of very effective treatment or vaccine surrounding this thing. A lot of what we have seen play out in financial markets is fundamentally driven, yes, in terms of, persons are pricing in a fall off in corporate earnings and just general activity. But I would argue that the bigger part of it is really confidence, right? Or lack thereof, and fear. And the longer this thing persists, and to the extent that it gets worse, and in at least in the Western world, we haven't seen a peak just yet. Confidence will wane and fear will remain. And markets, and by extension businesses, are chicken and egg, both are inextricably linked, will continue to do poorly. So while I think my base case is for this to be a fairly, relatively speaking, a fairly short period of downturn, months and not year or years, there is an outside chance that, and if we aren't one effective in containing the spread, and there is a huge fallout in the Western world, that will really put a sharp dampening on confidence. And two, if we aren't able to find some type of vaccine or cure, which is, I think, everybody's expectation, right? And again, that would be devastating.
Yeah, for real.
Yeah. The challenge with this is that it's not a typical crisis where you can deploy fiscal or monetary policy to solve. This requires a medical solution. And our situation is very unique, given that our economy is driven by a lot of external factors. We have the tourism, we have the remittance. So we appear to be doing a good job managing the situation. Our growth in cases isn't anywhere as high as what we're seeing in Italy or Spain or the US. So, but the challenge is that if we continue to have a firm hold on this, and we even get to the point where we eliminate, but countries like the UK and the US continue to struggle to deal with this, what do we do? Do we open back the economy when they're still fighting it, open back the ports when they're still fighting this disease, and then start back another outbreak out here? That is the challenge we face. So until we see a clear solution, which is looking to be either the best case would be a vaccine in short order, and hopefully it is be able to be produced in a large enough quantity and at a reasonable cost that we can get it and inoculate the population so we can safely open up back our borders. Because the challenge is that if, based on what we're hearing, that the US situation gets even worse, then however long it takes the US economy to get back to normal will impact how long we take to get back to normal, because the hotel industry is not going to just rebound just like that. People have to have confidence that when they go to an airport or they go to a hotel, they're not going to get infected with this thing again. So you might have some lag between when the World Health Organization comes out and say, yeah, we have this under control. We've beaten it back into a corner. People might say, yeah, let me wait 1 month or 2 months before I run out and say, let me jump back on a plane. So that is a challenge.
Yeah, somebody.
Yes, so Simon, I think basically what this does, it presents an opportunity for manufacturing firms locally.
Okay, also.
So basically, we are closing our borders. So many things cannot be imported here right now. So manufacturing firms, if you look at what is happening with oil prices, the government can basically cut the SCT tax and reduce the cost of the energy costs for manufacturing firms, and they can have an opportunity in producing and serving the local market.
Okay, but many manufacturers that to be manufacturers of goods that are based in Jamaica. So for example, like agriculture, for example. But many manufacturers will tell you that, boy, they rely on China and the US and Europe for their inputs. So right now, business for them may be much slower because that cargo is still allowed to come in.
Oh, yeah.
Somebody on YouTube said, they made an interesting point. They said that someone on CNBC the other day said, you won't see a bottom in the market until cases have started to level out. So markets will continue to dwindle down until then. Mark is asking you, Ivy, especially, well, he said, Ivy and Trevor, can we expect to see a productivity jump as a result of actions related to COVID?
Productivity jump?
And in other words, as a result of investments in tech that many companies are now being forced to make, can we expect to see that translate to above average productivity gains? And I guess he's talking about overall productivity, but I know you had spoken to labor productivity as well.
Yeah, I think over time you might see a jump in it, but for now, I'm forecasting that it will actually fall. So I'm waiting to see whenever the quarter's value added GDP comes out and the labor force. I'm going to do some calculation and see what actually happens, but I'm forecasting it to actually fall.
So what I think what Mark is saying as well is after the crisis, is it that because of a lot of investments that we assume are being made now, our productivity, I remember you were showing this productivity curve that's been on a downward trend for a couple of years. Do we expect that to increase or pick up?
Yeah, man, I expect it to pick up in the long run. Yeah.
Okay.
But this next quarter or so, I expect a fall in it from where it is at now.
Somebody's asking Arlen or Raman, what do you guys think about shipping companies like Mailpack? More and more people like myself, he was saying, are starting to just do their shipping services straight to their home.
Read the Mailpack. So just this week I went onto Amazon and I tried to order something and it said that the shipment wouldn't reach the shipping address in Miami till the next month. Now I have an Amazon Prime account. So apparently Amazon has taken the decision to only fulfill shipments for essential stuff, I guess, like food, probably whatever other items they view as essential. So I wondered how that would impact the shipping habits or the buying habits of Jamaicans, and then the subsequent impact on all these shipping companies, especially Mailpack. So it's hard to tell because the sellers can still do their fulfillment in terms of their shipping using another delivery service that they can probably ship it through UPS or FedEx or whoever, but that might probably come at a higher cost and it probably won't be as fast as Amazon service. So, and then how many drivers are out on the road doing deliveries right now? So you might actually see a fall off, and then fall off during this period in terms of shipping, especially when people, I would think, are prioritizing the consumer staple spending like on food and essential items and not the consumer discretionary.
Yeah, but maybe I think they're asking the question in the context that Mailpack also does local deliveries, not just overseas.
Yes.
Oh, okay. Well, from that standpoint, that's probably some of this with this we spoke about gig economy before, and then you're saying that people can go into delivery. So, and we've seen a couple of firms come out and say you can do curbside delivery. They've pushed their delivery service to say, okay, you can order your food online and we deliver it. So that is an area that they can flesh out more, and as long as they can build out that capacity fast enough, then hopefully they can see that lost business from the walk-ins being translated to an increase in the delivery side.
Local logistics, yeah. So just my 2 cents. I think it's definitely up and down in terms of business. I suspect the lion's share of their revenues now come from deliveries made from overseas. And I mean, to Alan's point, the priority of persons during this period, I suspect, I don't know about anybody else, but, I suspect, a few are the discretionary items that you usually focus on during this time. Those are probably on hold. So definitely opportunities exist locally to build out their logistics presence there. But I suspect how the business is currently positioned, they have more to lose from a potential slowdown in shipping to Jamaica, either through issues getting orders fulfilled. A lot of people, for example, shop on like Alibaba as well, which give you that direct Chinese situation. So either through that or either through just a downturn in discretionary spending. I think they have to lose on that side, and they might have to gain currently based on how the business is positioned from the local logistics setup that they have.
Okay. Interesting point, Ramon. So Jason McPherson, I think, he's asking, well, he's suggesting and asking if it's a wise way to do it. I know some of you guys are in research. Is it more or less wise to look at the performance of companies coming out of the last recession and gauge the impact this will have on companies in this pandemic or potential recession? So I guess he's saying, if look at the performance of companies that have been listed since and before the last recession, and how did those companies fare in that recession, and will that happen now? And I don't think we're officially in recession territory as yet, but how would they perform now in this crisis?
Well, good evening, everyone. I'm Julian.
Hey, Julian.
In my opinion, I don't think it would be a very strong proxy. Reason being, every recession is unique. So, last recession occurred because of financial stress. That was the root cause, and because of that, the economy responded in a particular way. Now, this recession does not have financial stress as a root cause. It has trading disruption as a root cause. What do I mean by trading? Because of the interruption in normal economic activity, it means that the transfer of goods and services would have been disrupted. What does that mean? It means that there are certain sectors that will be affected in a more intense way this time around relative to last time. So for instance, in 2008, we would have seen the balance sheet of banks getting a harder squeeze because they might have held instruments that were not quality. This time around, we may not see that kind of effect. We might see distributors, shipping companies, or even manufacturers getting squeezed, and even travel companies like Expedia, for argument's sake, getting an even greater impact, mainly because the root cause this time around is different. So I think the sector impact will be different. So saying that something is recession proof, it does have some kind of bearing, but we have to think a little bit deeper. We have to think about, okay, the fact that people are not traveling, the fact that people are not having one-on-one contact, it means that entertainment, for argument's sake, will get a very hard hit, because entertainment typically requires people to have very close contact, right? So I think that we'll have to get a little bit more granular and just put the recession within the particular context. This is a different kind of recession than last time. So that is my opinion on it.
Agreed.
Agreed completely, Julian.
Yeah, I agree with that sentiment, that given the fact that, because for example, we see the BOJ announcing a raft of moves to counter this. But as Julian pointed out, this is all related to trade. So if you pump all this money into the economy, with people not able to go out and buy and do the normal business and engage in commerce as you want, then it's all for naught. So as we said earlier, more looking at the companies with the balance sheet and the liquidity to really continue to ride out the storm is probably the best option at this point in time.
Yeah, right now companies are in survival mode. They're not in growth mode anymore. So we need to look more at liquidity in terms of cash, who has the most cash and who can manage their cash the best. So who can manage their debt levels and things like that. You're saying something, Simon?
Yeah, man. So we have some.
Yeah, man, Ashton, I have a question for Julian as well, right? So just like how some companies can ride out and can survive a recession per se, like do companies ever actually come out a recession strong in a stronger position than if they have and than how they entered it?
Well, it depends on how you classify strong. But I can just give you a random example
Sure.
to see how they can benefit. So typically, recessions, what they will do is, for some companies, it will bring them to their knees. It will allow them to reassess their situation. They might have to cut staff. They might be in a position where by the end of the recession, they might have very low cash levels. And because of that, they might opt to sell to a larger company. So the buyer of a weaker company might be in a more beneficial position, theoretically speaking.
Okay.
That's just one example.
So
Some companies might, say that again?
Yeah, so they can probably end with a little bit more assets because the dollar stretches a little bit further.
Exactly.
Yeah, man.
So, and they can probably buy another company within their industry. So they can take that client base, they can scale it, they can determine what they want to do with that company's product portfolio, if they want to adopt some of the products, they want to get rid of some of the products. So that's just one example, but there are other ways as well. But I don't want to overwhelm the discussion though. It's just one example.
Okay.
Okay.
And that's cool, man. And we'll have two very good questions from Slido. The first one is from Soti, Miss Soti, but I don't want to mispronounce her name. Soti. She says, I think Ireland had mentioned this. She keep hearing about strong balance sheets, right? But what specifically on the balance sheet implies that the company is in a great position now? What should non research people that don't have the exposure that some of us do to financial analysis, look out for on a balance sheet to know if it is quote unquote strong or not?
Okay, so when we say strong balance sheet, you're typically talking about two things, liquidity and solvency. Liquidity would speak to the ability of the company to cover their short-term obligations. So you want to have more current assets, more cash than you have current liabilities, debts that you have to pay, obligations that are become due within a year. And then solvency would more speak to the long-term financial strength of the company. How much debt are you carrying, long-term debt, and what's your ability to service that debt? Like, can you easily go into your pocket and say, all right, here, I owe $1 million this month. Do they have 100 million cash can easily cover that? It's not a big deal for them. Can they, based on how much debt they have and how much interest that debt bears, can they pay 1 year's worth of debt interest with no issues with a, say, a 50, 30, 20% reduction in revenues? That's what we're talking about. The ability of the company to really have a nice, we call it war chest of assets, specifically liquid assets, to deal with these type of situations where you still have obligations that become due, you still have staff that you have to pay. Can you find the money for that?
Interesting. So it's really just their ability to service their debt and have enough cash flows to pay their staff, etc., which is really the big problem. Somebody
Yes.
was an entrepreneur was mentioning to me recently that it's very difficult for MSMEs in these times, as one, they're the largest part of the economy. When they are hurt, the economy is hurt. And he was saying that so for their small businesses, because there's some requirement for employees to stay home, because they don't have that client base coming in to demand their products anymore, they don't have enough cash to pay their employees over a period of time. So what a few have had to do is lay off their staff temporarily, or unfortunately, some businesses may may be in a situation where they have to lay off or their staff permanently. So this situation can really pass over into other industries, because if you think about it, if less and less people have work, even if it's temporary, those people owe people, or they owe companies, and those companies owe other companies. So it can really be a spillover effect in
Ripple
a lot
effect.
of yeah, in a lot of instances.
Team, what do you think about looking at retained earnings as well? Maybe for persons who are new investors, what they can do is to just glance at the equity section of the balance sheet and look at the trend of retained earnings to see if the retained earnings are dwindling or if the company is able to maintain a certain level of retained earnings as a means of resilience.
Well, retained earnings is something to look at, but the reason why I spoke to specifically cash is because I asked for what should not persons who aren't affair with financial terms. Because the thing with the retained earnings that it is showing you the profits that the company has accumulated over the year that they haven't paid out in dividends, but that retained earnings could have been deployed into fixed assets.
Fixed assets, yeah.
So when you're in fixed assets now, or you're in let's say you're in investment positions that you can't easily exit, you're in problems. So focusing on cash or the current assets, like the cash, stocks to an extent, given if they're listed, you can put them up on trade, marketable securities, focusing on those type of assets are more crucial in these times, because cash is king. Because you don't want to go into a position where you're having to sell an asset to get some cash, but in this situation you're selling it at depressed prices. So you're going to book a loss, or you won't realize as much as you could in normal situations. So you might not end up that sale might not end up generating the cash that you really need, that you thought, or the cash that you thought you would have gotten for what you perceive the value to be.
Man, respect Ireland.
Interesting.
CFA at them.
I remember saying Ireland thing the normal, you know. So there was a very good question from Stuart South. He said, out of FinSac, we saw a slew of M&As. So M&As is mergers and acquisitions. Do you guys see the same occurring post COVID-19 or post this period of crisis?
Yeah, man, looking out for M&A activity for sure.
Yeah, so I agreed with Julian. I think he made that point earlier. So where I see opportunities is really in situations where, so you have a number of companies on the exchange that are well positioned to be acquirers, and you know we have seen over the course of the last 5 years or so a good bit of acquisitions happening. I think, frankly, this crisis may present even more opportunities for those companies, given that, you know, not only the values in our portfolios are going down for those who are invested in listed stocks, but naturally the values of private companies would be going down as well. So they could well find themselves in a position where, you know, companies that they would be prospecting to be acquired may end up in situations where they feel more compelled to sell, you know, given the change in business conditions. And I mean, they may be able to realize those acquisitions at lower prices. So for sure, I think there's many opportunities.
I think even before this crisis is over, you might see a situation where that sort of activity starts to happen, where, as we say, going back to the companies with strong balance sheets who are flush with cash, the opposite, on the opposite side of the spectrum, you'll have companies that don't have the cash, who might end up defaulting on loans, who might not be able to keep staff, and not be able to even survive to the end of this crisis, and may reach out to somebody and say, all right, I'll give you half of the company, 40%, we need some capital, help me out. Like, and for the stronger balance sheet companies now, they can be a lot more aggressive now because the really good companies will be looking around the landscape and seeing, all right, who's supposed to be struggling now, and give them a call and say, yo, you're probably not doing so well right now. Let's sit down and talk and let me see what we can do for you and take advantage of the situation. Because frankly, that's the sort of people that sort of mindset make money in these situations because they see that, for lack of a better word, they can exploit the situation.
So, Mark, yeah, good point, Arlan. Mark had a comment on the retained earnings discussion between Julian and Ashden. Well, Julian and Arlan. He was saying that a benefit of retained earnings is that yes, a good amount of it may be in fixed assets, and as such, it's not easily converted to cash. However, that company has the ability to borrow against their capital base or retained earnings or their asset base in order to fund working capital initiatives to kind of ride out the crisis. David was also commenting that companies such as cargo handlers in these, from last I remember, had little to no debt. Main events have large amount of current assets, especially cash.
Yeah, man, that's a good point.
Yeah.
Yeah, for sure. Yeah, man. Noted.
And I mean, as since we have kind of shifted over to the capital market side, I wanted to ask questions surrounding this IPO environment, because a long time ago, and it seemed like a long time, but guys, it's really just been a couple weeks. The sentiment, the investor sentiment in the market just 3 weeks ago was materially different from the investor sentiment today and yesterday. It has changed so much. So many investors have, many advisors from across the industry have said to me, boy, Simon, I have these clients, they come in, them have this money put down, and them say, you know what, just buy stocks with it. And boy, we talk to them about risk, etc., etc. They did very well, but now everything is coming down. The market is down 30%. A lot of stocks are down 30% and more. And what they've been doing is panic selling, right? So since investor confidence has been hurt, do you guys think that the IPO craze environment will continue post-COVID? Or will it even be at the same level that it was?
Well, it depends on when fundraising starts again. I think that if the deals teams wait until things recover and normalize a bit, then we could start to pick up momentum, because it's a curve. Because more IPO fever didn't start out the way it was, say, last year, for argument's sake. It got to that stage eventually. So we'd have to wait until things normalize and level off a bit, and then one person come out, then the other person come out, and it takes its time and builds momentum again. That's my view on it.
So something just came to mind, and we were in this kind of IPO craze, and maybe immediately after this crisis, we're going to an M&A or merger and acquisition phase. But Julian, you're perfectly correct about the timing. So, well, I can speak to some aspects of the capital market side, and timing will be very important because, well, you guys know that when you're listing a company and on the stock exchange, you want to get the valuation that best matches what investors are expecting and willing to buy, and what the companies are willing to sell for, or the owners of the companies are willing to sell for. So the valuation, and just to kind of simplify it a bit, the PE ratio of the market is important. And in an investor who would have wanted to list a week ago were in the pipeline, there were quite a few that were in the pipeline, may say, boy, the market was averaging above 20 at times adjusted for outlier PEs. And now the market is down to 15 and less on average. So I am going to wait, and the deal teams, as you said, Julian, we're going to wait until this thing kind of plays out and somebody tests the water, and then we'll try to push back. But do you guys see investor sentiment coming back? So not necessarily from the sell side, but from retail investors themselves, who would have probably come into the market and started investing without full information of the of what may happen in situations like this.
Yeah, so I mean, definitely going kind of be a similar situation to, you know, the progressive manner in which deals will return to the market, in that certainly persons are going to be scarred by this experience, right? You know, particularly fairly new investors. And as a result, you know, you might see them step back for a bit away from the market. You know, you find that after every negative market event, not just in Jamaica, right? As well too, fundamentally, you know, the lasting effects of this crisis, which, you know, will culminate in, you know, job losses. We've already started to see some hopefully temporary layoffs happen, as well as just generally, you know, less discretionary income, maybe in some instances. Those fundamental factors are going to, you know, adversely impact investing activity. But that being said, though, you know, it took a while to build investor sentiment to the level that it got to. You know, the sharp fall and the short time over which it has happened is definitely going to hit it. But that being said, you know, I expect it to again correlate with how the market moves and how the underlying economy moves post this crisis.
Yeah, I agree.
Raman,
Go ahead.
Raman, yeah, sorry, Ramando, so post crisis, right? We know that the sentiment will fall off, right? What roles do you think, or who do you think should play the major role in to build back that sentiment then? Because even currently now, so say we are to take away the COVID, and I can see, just based on the ground, where the information isn't flowing how it should flow, you know, to educate these people. So post crisis then, who do you think should carry that burden, or should really take up that mantle to really educate the investors that would have probably lost then, or the ones that have been discouraged?
Yeah, so I mean, I really think that's a very good point and an important one, right? So certainly, I think the onus firstly lies with the securities dealers. I mean, the brokerage community. You know, coming out of this crisis, so you know, there are a number of sayings that kind of center around this particular concept, right? I mean, you can tell somebody about something and they can talk, but you know, when they feel it is completely different. So, you know, having casual conversations or having serious conversations is really advised, as well to tell you, boy, there's a lot of risk inherent in stocks, and don't put your money in one stock. And then seeing the market continue to go up and up and up, and seeing, you know, every IPO doubling value and that type of thing. There's a disconnect, right? So persons are actually seeing now the other side of the coin. Many people are seeing it for the first time. So I think this fallout in the market will definitely help to bolster the credibility of the discussions that should have been had already and will continue to be had when persons are looking to invest. I think
Oh, yeah. I have one more. I have a question for Raman as well, but you can go ahead first, Simon.
Yeah, I was saying, Roman. So you're basically saying, my understanding of what you're saying is that this is somewhat healthy, for the market in a way, because it will help to
What a word, Simon.
Yeah, Simon, I
Sensible.
wouldn't say healthy. It's better to say it's a
Yeah.
medicine, as in it is a
Yeah.
lesson that is needed because it's the 5 years of abnormal growth. So people may start to think that stocks only move one way. So you
Correct.
start getting to the point where people say they will just throw money on an IPO, not understanding that is not every IPO go up. And even before this crisis, we started to see some of these IPOs not exactly doing what not performing how a lot of people are expecting out of the gate. And then now this will probably allow investors or make investors realize that these things, the stocks are inherently risky given how wide they can swing and how fast they can swing. So they're more careful in decision making, hopefully engage more with their advisors, demand better service from their advisors to say, okay, these are my circumstances, these are my goals. What can I do to achieve this with a level of risk that is something I am willing to tolerate, now knowing that this is a potential risk?
Yeah, I mean, I agree. And the second point I wanted to make, Simon, I don't want it to be lost, is that it is important that, a lot of the forums, to include this one, that have, kind of emerged on the back of the upward movement in the market and the increased interest broadly in the market and investing and, just general financial planning. It's important that, these forums are as strong as ever, right? To kind of, again, shed some light to a lot of what Alan just mentioned, which is the other side of the coin, and why just concepts of diversification, are important, and investing appropriately depending on your risk tolerance and your ability to take risk. Just kind of re-emphasizing why those things are important. So I think these forums will play a big role as well.
Okay. So, my question, right? So, for Raman, but maybe Ireland can pitch in as well. So, the actions, right? So, most of these brokerage house or these firms, they're actually saying that don't panic, everything is going to be all right. We can ride out the storm. But then when you look at the publications by these said companies, right? I'm seeing where a connected party is selling a couple million a their shares. Directors are selling shares. I mean, as a lay, how do I react to news like that? They're telling me don't sell, but yet internally they are selling themselves. How do I process that kind of information?
Ramon, you want to go first?
Yeah, I mean, I'll take it first.
Okay.
No problem. So, I mean, I can't speak broadly, but I can make some broad strokes, right?
Mm-hmm.
So, one is, to the extent that you invested in stocks appropriately, given your tolerance and stage or whatever it is, then, selling heavily during a market correction is typically not the best thing to do, right? So if your portfolio has the right amount of stocks, again, selling heavily during a market correction isn't necessarily the right thing to do. So I guess that statement is in support of some of the broad messaging that you might be seeing.
Yeah, man, but yeah, man, that's what the messaging saying, but the directors
Yeah.
themselves are selling.
Yeah, man. So let me go on the back of that. And again, I can just give a blanket statement here. I mean, there might be many different reasons why persons, may sell shares. Persons of all kinds, right?
Okay.
I mean, one thing that I'm sure is persistent across the market right now is that, in situations where, and this is just an example I'm giving you, right? In situations where people might take a loan against shares, given how the market has moved, you might well see situations where these people unfortunately have to liquidate their holdings to, meet their obligations, right? That's one thing. Two, as I said, there might well be many different reasons. It might be coincidental, and it might just well be that director having a view to sell, So I wouldn't say you have to assume that the disconnection between those two variables have a significance. I wouldn't say both things are connected in a significant
So we have to understand that even directors, at the end of the day, they are still humans. So they are not exempt completely from the same panic that a normal investor would have, because
Definitely agree.
they're still humans, and if they are intimately aware of the situation of the company and saying, boy, this is going to be rough, and a lot of their worth might be tied up in these company shares, because as you said, they are human. So a bias that some humans that has been noted in investors is that they work at a company, so they feel like, okay, I know more than anybody, and especially at the higher levels, they believe they can steer the company's direction, so they invest heavily in it, probably at a level that is not fiscally responsible, like you're completely putting all the eggs in one basket. So now when the market turn and you see all this happening, now they're seeing the risk to that.
Okay.
So they're saying, okay, maybe I need to get out of this thing now. Maybe I need to have cash on hand because any card can play. And I think a big thing that is, I strongly support the argument in regards to borrowing against your shares. It's a very common practice in the industry. And some people might be worried about margin calls, if not having already gotten margin calls from their
I'm
from the
sorry,
lender.
Arlan, what's a margin call?
All right, so a margin call. So when you borrow against shares or financial securities, there needs to be a buffer between the value of the loan and the value of the securities backing it. So let's say it's a 20-30% difference between the value of the loan and the value of the security. When the security then falls 30% in relation to the loan, the lender is going to come and say, well, you need to either give us more shares to increase the buffer back to where it was, or you need to give us some cash, or we're going to call the loan and take all the shares that you had put up as security against this. Some people might decide, okay, I need to get out of the loan, so they sell the assets and use that cash to pay off the loan, because they probably don't want to be servicing that debt in a situation like this. There could be a wide number of reasons, and it could also be something like somebody's decided to buy a house and them signed the agreement already, the documents come through, and they need to sell to pay the people them. It could be something as simple as that. Because I think that most directors would be aware that they have to report the sale of shares, and a lot of companies even require that directors make known their desire or the intent to sell shares, because they know what that transaction, they know the potential impact that transaction may have on the market. So we hope, or they should be mindful of that and would not be making that decision lightly.
True.
Yeah.
I have something that that I want to add to. So what I realize is, or I basically see that it's a belief, or people seems to believe that because we are in a crisis now, then business stop, and that is probably not so, because directors basically can very much be closing an equity position to, fast track some mergers or acquisitions or some purchases that they wanted before that have now become attractive as a result of the crisis. So, the general feeling or thought that it is only panic kind of sends the wrong idea, because for some of these persons, even in crisis, the opportunities come and they probably need cash to execute on those opportunities.
Yeah, and just to probably kind of close out this point, remember guys, every time somebody sells, there's somebody on the other end buying. So while you might interpret the reported sale as, a lack of confidence, remember that on the other side of that trade, there is a whole lot of confidence and, money that's put behind it.
Yeah.
So just food for thought.
Okay. So just to kind of touch, well, we've already spoken a little bit about value investing without touching value investing. So a lot of investors that say they're value investors have come out and said, hey, this is a wonderful time for us. We are looking at fundamentally undervalued stocks. Now that people are panic selling, we are buying them up for a medium to long-term horizon. Do you guys support the argument that there are multiple stocks on the stock exchange now that will benefit, not only benefit, we'll see a sharp increase in price once things normalize?
Simon, I'll just speak briefly on this. I mentioned it earlier that all of us have to look at what's happening within the context of the sector and how companies are affected by particular sectors. So it might be a mixed bag, and we have to consider who can manage your cash the best given the circumstances. Now, barring that, I just want to make a comment. I see an argument about us buying stocks because there's a pullback. Now, that's one part of the equation, but a pullback during a recession and a pullback during an upbeat economy is two different situations. So the reason to buy stocks during a period of decline is just one piece of the argument. You have to round it off by thinking, okay, these stocks are cheap, but is this company likely to have a deteriorated financial position because of what's going on, right? A pullback in 2018 would have been a different situation than a pullback now because of what's going on economically. So we just have to round it off with that kind of consideration. That's all I want to say to investors who might be hearing that argument online.
I think definitely there may be opportunities, or there are opportunities that exist right now from a value standpoint, but investors should be mindful that, as Julian pointed out, that if in fact we end up in a recession, we're talking about 2 or more quarters of negative growth, that the return to previous levels is not going to happen overnight. So you have to be patient. So the same mindset that would have drawn persons to participate in IPOs with the expectation that they can sell in a couple of weeks and it's going to recover, you definitely can't have that, because as we discussed earlier, nobody knows for certain when when we will get past these challenging times and the economy will rebound. So you have to be prepared to go the long haul with the investments that you're seeking to make, which has been the hallmark of good investing even before this. You look at a company and say, this company is going to be here for a couple of years. Well, they have a vision that they have the ability to implement, and outside of acts of God like this, they should be able to achieve it. So you have to be mindful of that and be aware that when you go in now and you say, okay, this feels like the bottom could be down the road in terms of we might see explosion in more COVID cases, and then the confidence erodes further. Then what you thought was a good entry point ends up being a high watermark for that week, and then the stock price drops even further. So you have to be prepared for that level of volatility as well, and be very confident in the picks that you make, that is okay, which goes back to the balance sheet, because a lot of companies may look good or may have looked good before, and then now they might not come out on the other side of this.
Understood. So as you said at Ireland, on the same point, somebody on Slido said, Wysinco is a manufacturing and distribution company. They're currently trading at $14. Do you see a sharp uprise? I mean, well, you know where this is going. Do you see a sharp uprise in their stock price in the future? Is Wysinco something that I should be focusing on? They have almost $4 billion in cash.
All right. I won't be making specific stock recommendations on this platform because I don't know what that person's situation is like, if it's appropriate for them. That's the first thing somebody needs to know. So I will say that Wysinco is a major manufacturing company. They've been around for a very long time. So they've gotten to their size in what you could call a stagnant economy over the decades. So that is a testament to the strength of the management team and the guidance that they've given the company over the years.
Okay, interesting. I mean, I'm just browsing through Mayberry's trade sheets. I mean, I usually use Jane's, but I don't have that today. I'm browsing through the trade sheets and looking at the PE ratios, and I'm telling you, man, they are, a couple of them are actually well below 10 times. But there was another question that I got off here. So last year,
oh,
and I think
hold
the
on,
year
Simon,
before,
one question. I think there are comments in the webinar chat, which is separate from the Q&A, that some people saying they might not, that you might be overlooking.
oh, all right. I'm gonna look at that now. But read the question around just that ask, man. Yeah, so let's look at this. So Ryan Burgess, he was saying that, oh, he was making a point. He wanted to add that some businesses, particularly manufacturers, not food manufacturers, are fulfilling paid contracts and are busy for the rest of the year. His suspicion, though, is that those doing well will opt to be silent now. So I know one specific manufacturer locally that, I mean, the last I spoke to him late last week, he was on top of the world. He's more a manufacturer and distributor of a consumer staple. So that goes back to what we were saying before. And he was saying that, and this may be helpful to some people in their analysis. I asked him, I said, what part of your business is the hotels? As a matter of fact, I think a good amount of your business is the hotels. And he had said, well, yeah, and the hotels are closed down. But for his particular good that he sells, he's saying that the demand for retail is so much that he has surpassed the amount that he would make with hotels, just from people buying his product more retail now. And he's looking to possibly expand coming out of this. So that's one thing. Yes, I was saying, sorry, Arlan, I remember what I was saying about the funds. So a couple funds would have been listed last year. And when I say funds, these are really just pool investment vehicles that collect money and use that money to invest in a predetermined investment strategy. So you have Sagicor Select Financial Index, Sagicor Select Manufacturing Index. You had Mayberry Jamaica Equities from I think the year before, and QWI. What would be your outlook for companies like this? Arlan or Ramon or
Yeah,
Julian?
sorry, I was muted. Yeah, I view them the same way I view the individual investor. They're just on a much larger scale. If anything, they should be in a better position than most, because when you're operating at that size and when you're taking control of people's funds, it behooves you to be prudent with those funds. So those companies supposed to have in place a sort of investment control parameters that protect them in a situation like this, having a well-diversified portfolio and a variety of industries that are typically resilient in economic downturns. Those are the type of strategies that you expect to see for the managed funds. For the select fund, the select Sagicor Select Financial and manufacturing, no, those are just passive funds. So you're just going to see, they're just going to reflect what that sector is doing, and investors will be going along for the ride. So if you're expecting the financial sector to do well because of stringent regulations and being well capitalized, then you should be fine from that standpoint. If you believe that the manufacturing companies, if their exposure is in consumer staples, that they will be doing well, but they might be dragged down by the ones who focus on consumer discretionary. But for the funds, these funds typically have long-term horizons. They're not investing with a short term, with the next day, the next quarter in mind. These guys trying to make consistent returns over a period of time, that when you look on the average growth rate, that it should be smooth, with the expectation that markets go up and down. So 1 year might be off, but the long-term 5-10 year outlook is a positive growth rate.
Yeah, so somebody called Casey on YouTube say, thanks, you guys may send him go looking at balance sheet, much respect. But he was saying that he realized, I don't know if it's realized now by looking, that a lot of companies actually have large investment portfolios, companies that are not necessarily investment companies. How would that affect their overall profitability, guys?
Yeah. So maybe I'll start on this one. So yeah, that's a good point, and that has been kind of an emerging trend where, as some companies have done better over the last several years, and even before then, they've built up, greater surpluses, and typically those surpluses would have been exclusively held in cash and near cash. So, even if they ventured into the securities dealer sector, they would be invested in like repurchase agreements, right? And, because nominal interest rates have gone down so much over the last 6-7 years, in particular post NDX, National Debt Exchange, a lot of investors have kind of ventured, in some instances unknowingly so, into riskier waters, right? So they've really started to invest more. They see what's going on in the stock market. And I mean, you have a number of regular operating companies investing, heavily in risk assets like stocks, right? So essentially then, I mean, if you think about even the Jamaica Teas case, where, Jamaica Teas ended up having an investment business of sorts, almost as, or well, just as large as their operating company. So that being said, naturally, to the extent that these companies have heavy exposures to the stock market, then, we could see, we should see that translating in their financial statements going forward adversely.
Okay, understood. Any other comments? All right.
Wait, Simon, I was muted, sorry. Just briefly, we should consider that quite a number of companies have securities on their balance sheet. So not just JAMTs, but quite a few, because sometimes firms might have extra cash and they might take some of it and buy equities or even other securities, but some of them will be impacted by the pullback in recent times. So not only would their core operations be affected by economic stress, but the pullback in the market itself will cause their balance sheet to be impacted as well negatively.
You know, as you said that, Julian, insurance companies came to mind because insurance companies usually use, and I'm no expert at this, they usually use excess that they have to build up an investment portfolio that can help to support their income, their premium income on their income statement. So
Yeah.
insurance companies that have large equity portfolios may be affected in a similar way. Arlan and Julian?
Yeah. Well, from what I can remember, yes, it would be applicable. But from what I can remember, just off the top of my head, insurance companies rely heavily on cash equivalents, and fixed income. They do have some equities as well, but I think the fact that global yields are trending downward, that would hit them harder than our equity market pulling back, for argument's sake, because their weightings are typically more closer leaning to fixed income. But don't quote me on that though. That's just off the
Yeah.
top of my head on a Friday night.
Yeah,
Yeah.
I
So
can concur with that. From my recollection, insurance companies have a very small surplus relative to the entire size of their investable assets that they can put in risky assets, which stocks would fall under. So they have exposure, but I don't think it's that much that it should be that deleterious to the overall performance
yeah.
if
So
they're being prudent.
just to put my 2 cents in, I think this is kind of where the variability argument that I was kind of pushing earlier comes into play. Because I mean, I agree with Julian and Alan that the typical case should be that a general insurer, for argument's sake, should be more conservatively positioned and therefore focus more on fixed income instruments. But the a major part of insurance, well, general insurance companies in Jamaica historically have been their investment portfolios. So, how these companies make money incremental to the premiums that they collect for the core business is that they invest those premiums, which is referred to as the float, in order to generate income. Now, in Jamaica, because we had a high nominal interest rate environment historically, a lot of insurance companies used to, just write policies, collect premiums, make losses on their core insurance business, but the investment income used to make up for those losses. Right? Now, what we have seen, at least in my experience over the last decade or so, is that in Jamaica, with investment yields kind of coming down, a lot more of the insurance companies' profits have had to be focused on the core business, right? So you see insurance companies getting a lot tighter with their underwriting and trying to ensure that the core business makes more profit. And two, I have seen personally where the risk appetites of these general insurers have also increased in tandem because falling interest rates, they're looking for where the investment returns can come to supplement the core business. And I'm willing to, based on the few cases that I've seen, I'm definitely inclined to believe that their weighting as an industry in equities might be, certainly more than it was 10 years ago. So I think the exposure today certainly a lot higher, in my view, to the equity market. And I definitely think that we may see a downturn in investment income in these companies in quarters to come. That's my position.
Wow. So a lot of the insurance companies listed may be hit. Another one that we never really touched on was the microfinance industry. Um, the and I guess it depends on the structure of their loan portfolio, as Raman had alluded to before. It depends on the specific company and how they are positioned. But microfinance companies that are heavily exposed to borrowers in the tourism sector, and other sectors that may be materially affected in terms of their income may also be impacted as well, at least over the immediate term.
Yeah, because the whole microfinance industry came about because they couldn't access traditional lending, and the traditional lenders would have much stricter borrowing requirements, which would mean that the people going into the microfinance companies to get money are higher risk and probably come from industries or in job positions where the income probably isn't stable. They're not on a fixed salary. They're not a permanent employee. So in a situation like this where the country's partially locked down, those type of jobs probably being impacted a lot right now. So you can, that's actually an industry I wasn't even thinking about, but they definitely are likely to see a significant impact on this, as if this goes on for a prolonged period of time and people just stop paying down on those loans.
Interesting. All right. So let me just check if there were any questions coming out of what we just said. For the guys on YouTube, Slido, or the participants on Zoom, you can send your questions as it pertains to those. Remember, I think all of the panelists have explicitly said they're not giving any specific stock advice, but this is an excellent time to ask questions of these guys. Forget a man like Arlen and Raman sitting down in one virtual room, it's almost impossible. So somebody on YouTube said, gambling is a staple for Jamaicans, and gambling tends to strengthen in a crisis. So people wanting to get money quickly. Do you see them as faring well coming out of this crisis? So, I guess them, he said it, them being SVL here.
Wait. Can I just talk about that from the IT perspective, Simon?
All right, Ashton, go through.
All right, so we had mentioned it earlier, right? In terms of the unbanked and stuff. Remember that COVID, we have to limit the amount of physical contact with people and so forth. So the way that SVL typically operates now, the way majority of the people go about participating with cashpot, etc., is by physically going into these shops. If there was a way where SVL, let's say, they took some of their business online and included majority of their participants in there, then for sure they would have gone through properly. You know what I mean?
But don't they have an app where you
Yeah,
can purchase?
yeah, they have an app, but how many people actually use that app? To be honest, like the average person that buys cashpot, is not someone that's really, I don't want to say the word like too articulate or
Tech savvy.
or tech savvy, you know what I mean?
Yeah.
And so that kind of put them in a box, kind of limit them in terms of, if they have
Customer base.
Yeah, the customer base kind of strictly just walk in the old-fashioned brick and mortar, etc.
Funny that question came up because just today I was reading an article, and the article discussed the two largest lottery companies in the US, and it stated that the Powerball was looking to reduce So what happens that every day there isn't a winner for the Powerball, the pot increases by, I think, 10 million. Don't quote me on that, some figure, but I recall 10 million. And what they're saying they're going to do is that because of the limitations on how many people can be on the road going into stores, that they're expecting a significant fall off in ticket receipts.
Okay.
So what they're saying is that they're probably going to end up cutting the payout, the increase in payout to 5 million. They were looking to halve it because they're expecting people not being allowed in a lot of these states to even go on the road for anything but groceries. So they're expecting to see a steep fall in how many sales they generate during this period. And I can imagine that that might be the same for SVL, especially when you consider that a portion of their business, I believe, is gaming lounges as well. And my understanding is that you can't have more than 10 people in an establishment at any point. So the gaming lounge is definitely going to see a significant hit. Sports betting done. There's no organized sport going on right now. So that business line, which they've been trying to drive a lot. They've spent a lot of investment on sports betting to get it on mobile apps and such, and that's dead right now. There's no revenues coming in from that. So
no sports at all.
They should see a pretty big fall in terms of the number of people that walking in and buying tickets, and then they're not generating any revenues on sports betting right now. And I was seeing the FA thinking that, oh, maybe we can start back in June. So in April, May, 2 months of revenues that for sure looking like it's out.
Yep.
Yeah. So well, I honestly probably I didn't look at SVL in depth, but I honestly never had that perspective before. But that definitely opens up that for me. Let me check on Ivy. I think I have a question for you specifically on YouTube. Deidre and Burrell, she said, "Can I speak to the gig economy guy?" Well, we had answered this question before, but just briefly, Ivy, for the people that would have just come on, what does it look like? Like a Jamaican fever? Is it that the company will be five? Oh, yeah, sorry. Is it that companies? Yeah, me forever so me know something here. So is it that
pronunciation?
Is it that companies will be sourcing consultants from these sites? I think when you say gig economy, Ivy, people probably are thinking that it's more complex than it actually is. So
No, it's
so
not.
what is it? What is it exactly? That's what she was asking.
Right, so for example, let's get on to the basic stuff of a gig, what people call a gig or a side job or something like that. It is really like a side job, basically. But the thing is that I've looked at some things, I've been doing some research on it, and it shows that 1 in every 6 employed traditional worker is in fact a gig worker also, because they actually do something on the side. But this is now just true, and I'm looking at it from the lens of an online platform, as though the world of work is actually going to change.
So hold on. So Ivy, you are say suppose, all right, so Julian is an analyst at a brokerage firm, right? So if Julian go to work Monday to Friday, have him 9 to 5, and he's an analyst and probably work a little later. But in the evenings and on the weekends, him father have a little farm. No, our father have a little farm where him sell pear and sell things like things like that on the side. That's considered like a gig itself.
A gig, yeah.
Okay.
But Ivy, how do you measure the development in that then?
No, that's the thing that I'm saying. I've been looking at this thing and thinking that when you look at, I'm looking at it, looking at it in the context of the crisis that is here, where many people, for example, people in the tourism losing their jobs, and based on, we don't know how long this crisis will last for and how many people will become unemployed. So I'm looking at it in the sense that in the event that we have another crisis like this, and also from the perspective that we are entering the fourth industrial revolution is emerging. I'm looking at it in the context of how the world of work will actually change. More things will be online. So I'm trying to get this type of thing in the minds of Jamaicans where we, as I said before, we are not really forward looking and we tend to wait until the environment, the global environment has changed, then we just trying to get to it. So I'm trying to bring this forward so that we can have more conversation around it. I don't have all the answers for it right now, but it is something that we all can look into. So basically, how I look at it is basically that from a perspective of a person who is unemployed, if you can develop some form of skill that is valuable in a digital context, then you might be able to make some extra income.
Okay, so Ivy, somebody said rotted all this time they are think gig. It's from the IT perspective, so like gigabyte. so they thought it was specific, and I must admit, I was familiar with. So I usually call it pay per hour services because there's even a site that is people per hour. So I did not know of the term gig economy. So when I first hear it, me kind of sit down and exactly go Investopedia exactly what this gig is. But yeah, I understand that now. So that was just a brief outline for Deidre and for the guys that would have joined after that. Somebody had a question for I guess Ireland, Julian, and Roman. What's the signal? Yeah, so on YouTube, yeah, it's like a side hustle. So however, what I found in reading about the gig economy, Ivy mentioned it earlier, but the gig economy is usually more geared towards the provision of services from an online perspective or from online platforms. So question, yes, this person said, what's the signal the international financial markets are looking for to start changing direction?
All right. So what we've seen are for some industries at least is a change in direction. Because I took the opportunity to look at the airline industry last week because in my mind, air travel can't stop. You might have consolidation where two airlines realize, say, yo, it's better if we come together rather than trying to ride this out by ourselves. But airplanes must continue. It's a faster way to ship people and goods than ships. So it's going to continue. And when you look at the stock prices yesterday, American Airlines and Delta went up 50 and 65%. And what drove that was the announcement of the benefits that the government would be, the grants that the stimulus package that the US government said they're going to be pumping into that industry. So in relation to the question, what investors want to see is a strong response from, I think there are two things that most investors will be looking at: a strong response from the government with strategies that they have confidence in, or an actual decline in the number of new cases where they can safely say, all right, I'm not talking like a one-day drop, like a consistent fall to say, all right, they look like they have the handle on this thing now. We're coming out of the worst of it, so they can say, all right, let me start running in before these stock prices really start going back up.
Okay, so thanks, Arlan. So Ramadan mentioned, well, both you and Ramadan mentioned something a while ago. Stuart South has a question on that. He asks, how prudent do you think it is for companies to invest in equity when shareholders could purchase these investments if earnings were distributed? So why are companies how prudent it is that companies are investing in equity when they really could have just paid out a higher dividend yield and then allow them shareholders to do whatever they want to do money, which may very well include investing in the equities themselves.
Yeah.
I think so. When a company said they're going to invest in equities, I think the understanding is that they want to hold a certain amount of cash or near cash securities so that they have the liquidity in when needed to do what they need to do in the normal business operations. They're more than likely going into equities because they want a greater return on that capital than what they would have generated leaving it in the bank. So yes, it's the flip side to that is probably going to be a little bit more risky, but a lot of these companies actually give a licensed financial advisor or company that portfolio to manage. So they will say Barita or any other portfolio manager, JMMB, NCB, I have X amount of money I want to invest in the stock market. So at the end of the day, it's still probably being managed effectively or to the best possible standard, given that when you come with $100 million and say you want to invest, you're probably gonna get a lot of the boutiques, boutique dedicated service, the highest level of service that these firms will provide that you probably wouldn't be able to access with the amount that you'll be going in with. So you're effectively benefiting from being in a collective investment scheme with all the other shareholders. So I wouldn't necessarily say, okay, yeah, just that's a next way to do, but then what you're effectively doing is reducing the liquidity of the company.
Yeah. Yeah, I'll be brief, but I agree with Alan to an extent. And what is most important is for investors to kind of, as best as they can, understand as much as possible about the operations of a company, and kind of recognize where the exposures are. I think for a lot of companies that are listed that actually do invest in equities is really more of a complement to their core businesses. So that's it more than anything else. But for other companies where that's where they park their spare cash, that may or may not be the best strategy. As I say, motivations are different. Return certainly motivates a lot of people. So that might be misspecified. It might be better for them to forego the return and keep it in cash, frankly, given that the business isn't necessarily an investment company. But I guess what I'm saying is ultimately it may be a complement to the business model, or it may well be completely misspecified, as I think the question is implying. Why are they doing that in the first place?
Okay.
Another consideration is the book value perspective. So the equity, meaning the net worth of the company, when we pay out a dividend, what that does is that it reduces the retained earnings. And when the retained earnings is decreased, it decreases the equity base of the business. So the company can make a choice. They can take that retained earnings or that cash that they might have and buy equities and keep it for themselves and allow that to grow, which would in turn increase the equity base of the business, or they can pay it out in a dividend. But the latter would actually decrease the book value of that business. So book value is essentially your assets minus your liabilities divided by your shares outstanding. So that's a book value per share. So they want to determine, all right, what decision will increase or decrease the book value of the business. When you pay out a dividend, you decrease your book value. If I take that cash and buy equities and keep it for myself, I would actually increase my equity for myself. So that's another way of looking at it too.
If anybody on Zoom has questions, you can raise your hand as well, and I'll let you talk to the guys directly. All right, so I mean, it's getting close to 11, so I wanted to touch on the last point that you guys are seeing on the agenda, the portfolio perspective. So Raman and Arlan is here now, and Julian and the rest of the guys can speak to this. From wait, before I touch on that, Jilly is still here. Jilly, Jilly drop asleep, man. All right, so we come back to her.
I'm here. I'm sorry. I had the Bluetooth on, so I was away from the phone. So I had to come back and unmute it. I'm here.
Okay. All right. So I had an interesting thought recently as it pertains to the real estate sector. So I
Yeah.
know you have more information on this than most others. So as it pertains to Airbnbs and the previous growth in mortgages that we would have seen, do you
Yeah.
do you think that there will be any major change in that or shift in that, not just in the crisis period but after?
I think after, well, definitely in the crisis period for the Airbnb, and the mortgages would be more on the sentiment side. So you're the unsureness or the riskiness of going into such a big investment when you don't know if you're going to lose your job or you don't know what's going to happen in the future. So I think there may be some pullback on the mortgage industry, like every other industry, for the short term. But in the long term, the things that I think might change with the Airbnb industry is that persons will now not see it as a riskless investment. I think a lot of persons who are doing the Airbnb, I've heard some horror stories of people with 10 mortgages doing Airbnb with 10 mortgages, and now they don't know what they're going to do.
Wow.
So,
Okay.
so I think that people will understand that it's not a riskless investment to do Airbnbs now. So they would kind of probably not put all of their eggs in that basket and think about diversifying a little bit more. That's where I think that industry might change. It might get back on board with the tourism industry coming back up eventually, but that, who knows how long that will take. So that's a consideration that might have some fallout in the short to medium term.
Yeah. So I'm looking at opportunities in a crisis.
Simon, I can add to
Driving.
that.
Yeah, man, Ireland.
Yeah, in addition, because I was reading up on this because I figured that this impact would be significant given what we see, where house prices going, and what apparently is demand driven by Airbnb hosts. But what I got to understand that a lot of people apparently abroad, I'm not sure what the numbers are like in Jamaica, but it's apparently a very common practice for people to rent long stay properties, like normal long-term rental leases, go in and establish a lot of leases and then sublet these properties onto Airbnb without the overall landlord being aware. So
Yes.
then you have 10, 20, even 20 apparently properties that you take out leases on. And all of these landlords are unsuspectingly exposed to the Airbnb sector now. And now they're going to find out say, they don't have any rent to be collected in the next couple months. So the impact might be greater than people realize from that industry.
Oh,
Well, what I can
that's
say now, I kind of agree with Arlan because, I mean, I believe that sector is going to be, I think there's going to be so many opportunities from that standpoint.
okay.
I think there are
That's where
going to
I'm
be
going.
opportunities coming up because, I mean, until last night, somebody just asked me if they said that somebody had put an offer on a property and was ready to execute, but they actually lost their job. You're a manager in one of these tourism-related companies, so they can't go through with that again. And I feel like just that extra demand that was driving up the Airbnb market would really present a lot of opportunities. I wouldn't go as far as to say that it will result in a significant decline in residential properties. But I do believe that there might be, even if it's a temporary, supply demand imbalance, which may present some amount of opportunities for investors, persons with cash and can execute quickly. I think that is an area where I think people can really look at.
And just for the listeners, that was Richard Gunn, VP at Proven Wealth. But I also wanted, so where I was going with this, is Richard touched on it, opportunities. So driving through Kingston, I'm seeing a lot of developments that are on the way to be completed. And a lot of the developments that would have been completed over the past, let's say 2 or 3 years, a good percentage of them were being used for Airbnbs. Now, based on these shifts that you guys spoke about in that specific sector, and as Richard just said, the fall off in demand. So basically, you guys are saying you expect prices in Kingston to, even if it doesn't recede or pull back, to at least moderate.
I'm thinking that's a possibility. I mean, you don't know for certain, but given the fact that the demand is probably going to decline even a little, there might be a price correction or price drop in residential properties. There might. It's a possibility.
So for people that one have more sustainable job, and I would say sustainable, who are sure of their incomes, two people that have cash holdings put down, there may be opportunities in the real estate market. For example, to buy properties from that person who has 10 leases or probably subleases on properties just for Airbnb.
I wanted to point out something. I always wondered about our real estate market because we've never normally seen any declines. From what I understand, after Cash Plus imploded, you saw a momentary fall in prices, but that softness recovered fairly quickly. I get to understand that from time immemorial, Jamaicans have a high value on land and property. Owning your own home is a big thing. So if anything, it wouldn't surprise me if we see a flight to what is perceived as quality, where Jamaicans go back to what they know, said, all right, the stock market thing, I don't know about it, but I can see the house, I can pass it. Because I spoke to a senior wealth advisor, and he was explaining to me that he has clients who will buy properties to rent or whatever, and if they don't get it rented, they'll just lock it up and they don't care because they have the financial means to buy several properties and just leave it there. They're very comfortable storing their wealth there, and they may have moved into the stock market given the clear returns that were generated in the last couple of years and said, all right, let me take a chance there. And they get burnt in this period and say, I never get burnt so buy no house, I'm going back to that. So I wouldn't be surprised if the fall off isn't as precipitous as we would imagine.
I can add something to that point, that even the 2008 financial crisis, which in the US, it was sparked by a mortgage crisis. It's a mortgage crisis that caused the crash of 2008. And consequently, Jamaica didn't have as big as a fallout in the mortgage sector because, of course, we didn't have those type of securities down here, the mortgage-backed securities. But we didn't have that big fallout down here in the mortgage industry. Prices, as you said, declined probably momentarily, and then they continue to go back on their upward trajectory. So yeah, you're right. I agree with you that there is a high value place on land and housing. So that's why I said there might be a slight decline, but I wouldn't expect anything too drastic either.
Correct. I agree with that. So a slight pullback in any way, I think would do the market a great deal. Speaking for people like me who would be very much happy to be able to afford some of these latte or apartments that are going in the market.
But the next thing is that you will probably have a lot of people who thinking the same thing, say, okay, maybe these prices might drop down. And as the first price change, you see way more bids coming in, and then they just end up in a bidding war anyway and just bid it right back up, or just below where they were before. And they only get a marginal savings on the price.
Well, maybe, but also, if a lot of apartments come on the market at the same time, yeah, that is where I think it the opportunity might come. If a lot of them come at the absolute same time. Because there's so many persons, and there are not many persons who can afford to pay rent / mortgage, and another Airbnb property comes up, they have that property they can cover with their current salary. So if persons have that 1 or 2 properties like that, for 2 or 3 months, they might find themselves in a problem, and foreclosures can increase.
I wanted to ask a question because I thought about it. That given the impact we're seeing on jobs, either people being laid off or maybe having to take pay cuts or being told, boy, you get paid a little late, and the subsequent impact on mortgages, what do you guys think is a potential scope for what we're seeing abroad, or we see some Italy saying all mortgages get freeze right now? You don't have to pay.
Really?
Do you
I can speak about an email I got today from my mortgage company that said that they were giving customers the option to defer their mortgage payments for up to 1 year. So the banks are
1 year?
the banks 1 year.
Wow.
But I'm sure you have to go
share
through
which institution is that?
Whoa.
JN. That's JN.
Pick up Jane.
So
I'm
I'm sure you'd have to apply and everything, but they are giving, and it wasn't just that, it was a list of a number of things for businesses and individuals that they're doing to help alleviate the COVID crisis. They sent it to all their customers, I think. So if you have a JN account, you should have gotten it.
So that underscores the strong balance sheet, because to forego 1 year's worth of mortgage payments.
They're not offering it across the board, you'd have to apply and show your circumstances and everything. But if you can reasonably do that, then they're giving you that option up to a year. So it's something
is it right to say forego, or are they deferring?
They're deferring. So you still have to pay your interest, but they're deferred for a year. So the companies are understanding that this is not a normal time. This is an unprecedented historic event. So they're trying to work as best as possible, as I know, because I know Jane wasn't the first one to come out with something to help alleviate some of the financial burden that we're going to face in the future. I think Scotia had something and NCB as well. So the banks are, I think, working with people as best as they can to help alleviate the situation.
Interesting. Very, 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 very interesting, because I know a few people that are looking for properties now, and a few have probably said that they're in the wait and see point now, because they expect some prices to moderate some. I wanted to touch on another point. Sorry, Richard, they said you had a question for Ramon.
Yeah, no, I was just wondering, with banks, almost, I don't know if they call it a restructuring, but would that be something that adversely affects some of the banks from an ECL standpoint? Raman?
I could answer that as well.
Yeah, man, go through, Julia.
So, of course, I don't know how many of you know about IFRS 9, and the reason why IFRS 9 came into place. So IFRS 9 is something that was sparked by the last financial crisis. It's a new accounting standard where we have to do very rigorous and detailed estimations and projections of our expected credit losses, which is what he just mentioned, the ECL. So the ECL calculations that have been built in the models for all of these banks that now are mandated, as of last year, they're mandated to do this new way of calculating what you expect to lose as a result of normal business and in a potential crisis, which I think this would fall under the category of a crisis. So the banks have really, really rigorous processes behind what they're doing and what they expect to lose. And I was even on a call earlier this week with our consultants looking at refining our ECL models, and immediately as this came to fore in the Caribbean. As it started to come up in the Caribbean, we started to talk about what the models are and how they need to be refined because of what we expect to lose in terms of credit losses. So the banks are on top of it, and if they have to defer payments, it's going to be calculated in their credit losses as well. So they're able to reasonably assess what the situation is and make provisions for it.
Well, yeah, that's what I'm thinking. That if that's the case, then this would impact like all of the banks and the banks. it would, so that's another line, that is another negative for that sector. Even if it's a 10.
I mean, yeah, and for brokers as well, Richard, to that same point, I mean, with,
Yeah, man.
you know, the inevitable downgrades that a lot of companies and countries that we invest in will get. I mean, Trinidad, for example, the credit rating moved down a notch this week. So to the extent that that continues to happen across the board, you know, that will adversely impact balance sheet and the profit and loss statement.
Yeah, so I think that's something that we need to probably take into consideration. So when we see the stock prices of some of these financial companies coming down, it's really probably a reflection of how the performance of the company might look over the next 12 months. So I think Julian had mentioned it earlier that, you know, it's not, we cannot say the stock price has fallen 40%, so it's cheap and it's a good buy, but there are a lot of ripple effects that this entire situation will have on these companies. I mean, we don't even know the exposure of some of the banks to the tourism sector. So they might not even have a choice but to give people a moratorium. It might not even be a moratorium. So we don't even know how much the expected losses they're going to have to take and write down because of these bad loans. So yeah, I was just wondering if that just, even though it's a good gesture, the negative impact that it would have on the profitability and a lot of these financial companies.
Guys, Jilly, is there, and just thinking out loud, is there any way that the government could help with those expected increase in credit losses by providing some form of tax credit against it?
They could always do that. I'm not sure if they will, because as you know, we just forgoed the asset tax, which is something that the banks have been looking forward to for quite a while. And then they had to forego it for another year. So they could, but I don't think the government is going to be doing any many bailouts or many exercises to help the banks during this period. I'm not sure about that. I don't know. I think they'd rather give it to the average person than to give it to the banks right now. That's just my 2 cents. I could be wrong.
Simon.
One second, you know, thinking about again, so even we're looking at properties, right? I think even the yields that we're looking for on properties, we'd have to even reassess that also. Because a lot of persons know, a lot of businesses have started already by saying that, listen, I can't afford the rent, you know, for the next, you know, my business has gone down, so I can't afford as much as I could, you know, can I get a moratorium? So even if buying a property, I think it's the same process we'd have to kind of think about. So in terms of, you might hear that this property of this size, you might be able to get $1,000 US or 100,000, whatever. You might not be able to get the same amount of income in the current environment. You might have to even be lowering the rent, that if you have a tenant, you might have to lower the rent for him. So I think those are the things taken into consideration why prices might come down slightly in the current environment.
Yeah, I just thought of the microfinance again when you guys mentioned expected credit loss, because if you guys are aware and keeping up with that sector, all of the companies thus far have reported a steep decline in profits due to higher provisions for credit losses due to IFRS 9. So I'm thinking that if with the change that they reported such big provisions, I guess because the standard is now a lot more stringent, in a scenario like this where we expect significant credit losses, what those provisions gonna end up looking like, and then the further impact is gonna be on those guys' results.
Ireland, even compound that, the main borrowing base is a very sensitive one because these are middle to lower income borrowers, right? So that credit portfolio has a much higher risk of default. It's not like a regular commercial bank. It's middle to lower income persons. Because to my knowledge, persons who are on the higher income bracket, them not borrow from microfinance. It's people who barely have it. Correct me if I'm wrong.
And they're going to prioritize the food and other essentials than, say, a little personal loan. So they might be really hit by this. So if anything, when we're talking about government assistance, we probably might see where that group lobbies very hard for some sort of help, because, and this this emphasizes the whole risk to reward relationship where people always wonder why is it that these companies charge such high interest rates and in the past would have had really high return on equities and do well, because if you've been in the market long enough, you know how Access has grown, how LASEF has grown, but they're not taking any small risks. Their core loan book is a very high risk group, which is why they typically charge much higher rates than banks, because in a situation like this, the entire table can be flipped over.
Interesting. Somebody had asked the JPS IPO. Well, Randy, we had spoken about that. It's really going to be due to the timing in the market. Sorry guys, you can continue. I'm learning a lot to read this expected credit losses thing. So you know, I really appreciate the knowledge. On the final major topic that we wanted to touch on, it says Raman Small Ferguson here, but all the panelists can really chip in. So the overwhelming question that I think a lot of people are getting now, sorry, Liquid One kind of slipped out a while ago, you know, is what's next for my portfolio? My portfolio is down 20, 30, 40, 50, 60%. Raman, Arlan, Julian, and Richard, how are you advising your clients? From a generally, so not necessarily in terms of stock picks, but what is your advice to retail clients now?
I think across the board, because of what's happening, investors might have to extend their time horizon, because it's not as if we saw this coming. Essentially, 2020 took a major turn. So if you had a particular goal that you wanted to achieve in 5 years, that goal might have to be posted in 6 or 6.5 years, just realistically speaking, to factor in the change that would have occurred this year. So that's one point. So I'll just leave it there. I'll just say that extend your time horizon and defer where you can and just reassess, do some homework, and take an even more patient approach.
Ramon, Richard, Arlan.
Yeah, Ramon can go ahead.
Yeah. Yeah. So I mean, I think, yeah, just generally, you know, we kind of touched on before that this is yeah, an event that I think investors can learn from. You know, a lot of the new investors who have come into the market over the last several years would not have experienced a decline. And I think, importantly, persons need to take stock of what this means and what this has meant for them and their portfolios, and kind of reassess whether the amount of equity risk that they've been taking is appropriate. Right. So, you know, now is really a time to rebalance, for sure. You know, I'm not necessarily an alarmist, you know, but as I would have said before, panic selling, you know, is really not necessarily the best thing to do during a crisis. So it's important for persons to be rational about the type of exposures that they're cutting. So, for example, I mean, a lot of the discussions that we've had tonight reach sectors that realistically there will be a lasting impact on a deep or sharp downturn in performance because of what is unfolding. You know, the most recent discussion was like about the microfinance sector, for example. I think that is really what should inform some of the decisions you're taking from a portfolio perspective, and not necessarily, you know, just the overall market activity, meaning, oh, this stock is falling, let me sell it. You really have to to look at the underlying and the fundamentals to guide how you act. Yeah, I kind of leave it at those 2 points and give the other panelists an opportunity.
Well, yeah, I mean, it's really about reassessing the portfolio. Your outlook will change, and it will change over time, and you just have to be realistic. You have to just you take the good and the bad, and you kind of simply just reevaluate. And for those sectors and those specific companies where your outlook has changed, and you may have to realize a loss, then we don't have that loss aversion or whatever much it's called. You don't have that. You kind of just take it for what it is, and once your outlook changes, you operate accordingly. So still have a fairly, I look at the situation where, the country overall from a fiscal standpoint is in a much better position than it was, probably 10 years ago. But the situation is much worse than, in my estimation, much worse than it was in 2008. So it's really just about rebalancing your portfolio. I mean, we understand that, equities, there's a certain element of risk involved in equities. So we kind of take the good with the bad. As we have done, we've had a long stretch in terms of capital gains. And this is just kind of a structural change again. So we reevaluate, we make our decisions, we alter the portfolio as best as we can to meet our new outlook. And we just consistently relook at all the specific investments in the portfolio. And we just make those decisions. That's it.
What I would say is that the first thing is don't panic. You make poor decisions when you respond to things immediately without taking a step back and assessing the information that you're getting properly. For the standard investor, I say it's a very good time to go in and speak to your advisor and say, all right, let's see how the portfolio looks. Do you have exposures in the sectors that are being impacted directly by this whole situation? Can those companies ride out this storm? Do they have the ability to do so? So then you say, all right, rather than selling at a loss, I can probably think about averaging down and saying my overall long-term outlook hasn't changed. I'll stick with these guys. If you realize that, okay, maybe I took some risky bets and these companies might be in for the brunt of it, I need to accept these losses and move on and reposition into the company that I believe that have the best chance of riding the storm out and saying, all right, this is where I'm going. But you really have to ensure that you're getting the best advice. You're not making any snap decisions and saying, okay, it dropped 30%, let me jump out now, when nobody knows where the bottom is. You don't know if, okay, it's dropped and it may go back up. I'm not predicting that it will, but nobody knows. So you have to really take your time and ensure that you're getting quality guidance while you're making the decisions about what you do with your portfolio.
All right. Sorry, Arlen. Continue, man. Continue.
No, because what I'm saying at the end of the day, when you're investing in stocks, this is why people emphasize having a long-term outlook. When a company says they're going to engage in a project, it's not something that they typically can do overnight and start making money. A lot of these projects are long-term. If you build up factory, you have to roll out technology, you have to test it. So these things take time. So whereas we see that this situation may resolve by the end of the year or may take a year, it's going to be resolved at some point. So you have to accept that if you have a 10-year horizon and at the end of the day, the company will be much bigger than it was before. In between, there's going to be volatility, there's going to be shocks. So you have to just accept that it's a part of the game when you're in the stock market and build up your resolve and ensure that you're investing in companies that have a strong resolve and can manage the risk and the shocks that may come.
Interesting, but Ireland, and no, I'm probably going to put you guys who represent. Well, I know. Let me just say it explicitly. Ireland is not representing his company. No, Rahman is not, and Richard are not. They're really just talking from their personal perspective, and using their their professional experience to help all of us. So my question though, and I was thinking about it today, most brokers have scaled down their operations in terms of their in-branch operations because of this social distancing thing. So you may naturally have less advisors in branch. Some will be working from home, etc. And there are limitations to how people can travel from certain areas and into the branch, a maximum of a certain amount of people. Where can investors get this type of practical advice from? Because the brokers have albeit scaled down their operations. So I know that I say Barita had a live stream today. So let me just partly answer my question. I was late, but I saw Horton, who's an analyst at Barita, on Barita Live, talking about some of the things that we would have spoken about here. Is this something that you think more brokers should engage in their client base online?
But Simon, I just got an invitation for JMMB's own. No, because
him probably don't want to have any conflict.
I don't want to be biased, I don't want to be biased.
As earlier in discussion, people are talking about how they can utilize technology to really, I guess, shift their business is to function in this new normal, at least for now. And as Gillian pointed out, JMMB is also doing a live stream. So I'm expecting that more and more of these companies are probably going to engage in stuff like that. And not just live stream, because the downside to going digital is that we don't have great internet penetration in the country. As much as, so like we'll see data coming out to saying that smartphone penetration is increasing, but most persons don't have a data plan that is fixed month to month. They're buying it day to day, so they don't have access. So I'm hoping that they have town hall meetings that are televised or broadcasted over the radio as well, so that all persons have access to the information and are able to get that sort of advice as well. But I see that as a low-hanging fruit in terms of reaching out to the clients.
Okay.
Simon, I think
And
there is a space for. Oh, sorry, Joe.
Oh, sorry. Go ahead.
No, briefly, I was just saying, Simon, that independent platforms like Stocks on the Rocks are very important, because what it does is that it gives somewhat of an independent or balanced view, because sometimes retail investors feel as though they're always being sold to. But something like this is very educational, and it has somewhat of a purist edge, because people can come and say, oh gosh, somebody not pushing a product in my face. I can actually learn. So I think it can be a mix, an ecosystem with brokers being more open and also independent platforms like these. So that's my opinion.
So, and Chile, I know you have a point. You can go.
I was going to say that both yesterday and today, PSOJ had sessions specifically geared towards business owners on how to navigate the financial climate right now. They were very good. One was today with Kalila, and the one yesterday was with Rochelle Cameron. And they were both very good. So they're going to have it every Thursday. So every Thursday at 4, I think. So you should tune in if you're really interested if you're a business owner and you want to get some tips on how to negotiate terms with the bank, how to get. I don't work for PSOJ. I was just found it very interesting that they're doing this, and they're doing it every Thursday.
Jimmy, so, and which platform is this on?
They do it on Facebook. It's on Facebook at 4 o'clock on their Facebook page, PSOJ, and I think the one next week is gonna be with Exim Bank too. So
excellent.
Yeah, so there are a few things you just have to figure out who is doing what where.
So and that comes to my other point, but I was leaning towards more the brokers, but we can open up the category. Do you guys think, or let me just tell you what I think. I think a lot of this virtual interfacing that businesses, the government are starting to do with clients and citizens are going to force um, them to understand how important communicating with your client or citizen base is. And it a broke bad. Right now, Mr. Andrew Holness every day. I see Christopherton every day. I have seen where brokers have the capacity like JMB and Barita to do live streams where somebody, an analyst like Harton or a portfolio manager like Peter and Greg can go on live and talk about what they would consider basic investment matters, but it would mean so much to us. So I believe that after this crisis, they, not just the brokers, businesses in general, will have less of an excuse as it pertains to communicating or interfacing with clients virtually, or may even be more inclined to do so.
Yeah, I mean, I agree. What I think that the crisis has done is it has accelerated that move because slowly, persons were moving towards using technology more. I mean, signs of the times, and we never had a choice. Some persons are slower to move, but I think that this crisis that we're in now, where we have to operate under a different regime, is going to really and truly change the landscape of how we operate. So the digital communication and how we communicate is going to be different. It's not just going to be, written analysis now. It's going to be more, different methods of communicating that same thing. So as I said, I do agree that, I think as a client, you can demand more from your broker now. So brokers are going to be under pressure now to ensure that you're meeting this basic, which is going to become now a basic demand and a basic necessity, so to say. So I do agree, but I do also say that I think brokers we communicate amongst each other. And I think we all agree that we have a greater responsibility in terms of educating the masses. We can do it in a much clearer way, a much better way, a more efficient way. So I think we have agreed that we can do a lot better in that regard. So I think that over the next 12 months, stemming from this, which as I said, would have accelerated that process. I think you'll see a lot more communication via digital platforms to investors.
Okay, guys, and I know time is kind of running from us, but there was one last thing. So panelists, if you can bear with me for a few more minutes.
Wait, Simon.
Yeah,
We
Julian.
need to ask our viewers to email us, please, to keep abreast of Stocks on the Rocks. So the email is stocksontherocksfl@gmail.com, right, Simon?
Yes, stocksontherocksfl@gmail.com.
Yes, please give us your information so we can keep you up to date.
Okay, so
Simon, can you display the email on the screen?
Boy, everything I work so good in the Ash day, and I don't want.
What somebody can do is type it in the chats.
I'll type it in the chat.
Yeah, somebody type it in the chats, please. So
Ashley, type it, please.
Yeah.
So the last major thing I wanted to discuss, and I mean the economists or quasi-economists can chip in now on all fronts. I know we have a couple people listening from BOJ on YouTube. Fiscal stimulus, even though BOJ is really monetary, but still, them understand. So fiscal stimulus. So what the government has been doing is outside of the funds that they have set apart for emergencies or for emergency purchases of masks, ventilators, etc. Dr. Clark has stated this thing about providing fiscal stimulus or providing cash and liquidity or opportunities for liquidity to the market or to the economy. Can one of you guys just briefly explain what exactly a fiscal stimulus is?
think you have to start calling some names, Simon.
All right,
Yeah,
so
man.
I'll take a jab at it, right? So the word fiscally typically refers to the government manipulating their spending. So is it a situation where they're spending more or spending less to stimulate economic activity, either to speed it up or to slow it down? So right now, what the government of Jamaica is doing is to increase their spending to stimulate activity because they're seeing that we're going to have difficulty down the road. And they have implemented certain measures to enact that that whole spur of economic activity. So that would be, for instance, a lot of the tax breaks, for instance. That would be some other things that they're spending on. Jog my memory, Simon. It's not coming to me right now,
Yeah, so
unfortunately.
Simon, what was the question?
Well, what
yeah,
is
so we're
fiscal
talking
stimulus?
about fiscal stimulus. Sorry guys, Ivy fell
Spending on
asleep.
pass is one of them as well. They increase that.
Yes.
Okay, so basically, we're talking about fiscal policy.
Yeah, man. What is it?
Okay,
Just in layman's terms, yeah.
so basically, within the whole economy, you can either have monetary policy or fiscal policy. So the fiscal policy is basically government spending or taxes. So the government basically uses those tools in order to expand or contract the economy. So based on what has been happening with COVID-19, the economy is basically contracting. So what the government is trying to do is basically expand it, or trying to limit the contraction by giving that stimulus now to basically keep people spending. So give them money so that they can continue to spend. So basically, there's a formula for GDP. Basically, you have the consumption plus investment plus the government spending and the net export. So all of that contributes to the total GDP, or what we would call aggregate demand. So basically, if you hold everything constant, the consumption part, once the consumption increases, then the GDP or the aggregate demand will also increase. So that is basically what the government is trying to do. Because the economic, the Great Depression, basically, one of the things was cited was that it was due to low aggregate demand or low spending that caused that crisis back then. So the government is basically trying to expand the economy by giving people more money.
Understood. So is it that the government, so somebody said something very interesting to me today. It was Dr. King, I think, Ivy. He said that trying to assess the impact of fiscal policies on the economy is like throwing a stone into the water and not knowing the size of the stone.
Yeah, because we don't know what exactly are the magnitude of contraction that this crisis will actually cause. So basically, by doing this now, as I said before, it's like throwing a stone and don't really know how far it is actually going. So basically, there might be a case, or we're talking about a scenario. So suppose that for example, the crisis causes the economy to contract more than what than the fiscal space that we have, but we have already spent out most of that money.
Understood.
So that is basically like what it was basically referring to today.
You know, there's a stance that economists usually have, that in times like these, when the government is forced to increase their spending and or reduce the amount of taxes that they collect to kind of, where I say, resuscitate the economy, right?
Mm-hmm.
It is expected that down the line, in order to meet the where I say no, as they spend more than they collect,
So you're saying that in the long
they have
run,
to borrow.
yeah.
And
So
because borrowing is expected to increase, you know, there may be some impact on future taxes. So the government may have to either increase borrowing to pay down spending that they may have to do this year,
mm-hmm.
or you know, they would have to increase taxes in the future. Do you think that this is a possibility, Ivy?
Well, based on as I said, based on policy continuation and based on the fiscal space that we have basically developed over time, I think that it depends. I can't say for sure no, but it really depends on the magnitude of contraction that the COVID-19 really causes. Because we have some fiscal space that we have never had before. So it really depends on the COVID-19.
One thing to note is that in a situation like this, the whole point of the fiscal policy is for government spending to come in and replace the fall off that you see in consumption and investment. But this situation is unique, that the fall off we're seeing is due to this health crisis. So you can spend all you want, but if the country is still on lockdown, the money that you pumping into the economy, it won't go anywhere. You won't get that turnover in the money to stimulate the economic growth you want. So I am hoping that the heads at the top are mindful of this and realize that to really combat this, we need to be spending a lot on the health industry sector to ensure that they have the resources to keep this disease down and get us through this with as little casualties as possible. Because if we're not in a situation where we have free movement of people as we used to, then it's for naught. We're not gonna get the turnover, the economic multiplier that would not be high in this situation. So I think that is a key thing to know, that we cannot spend, that we can't just throw money at this problem unless we're throwing money at it in the right places.
So a key note that I wanted to point out, let me just bring it up here, guys. Give me a sec. So I was looking at the ministers. I was reading through the minister's closing speech. I think it was in his opening speech, where he had basically stated where the money is coming from to pay down the I think about $80 billion worth of debt in October. So he had stated that around $12 billion, I couldn't find it, but I'm trying to remember, about $12 billion would actually come from cash from Wigton. I don't know if they have that in surplus now, but Wigton was stated about 12 to $14 billion would come from the intended sale of JPS and the mortgage bank, and the rest would come from surpluses that the government has from various agencies. And I was just thinking that if this persists, then the debt to GDP target of close to 80% or sub 90% that we have from March 2021 may definitely be in jeopardy from two perspectives: from a lower than expected reduction in debt and from a contraction in GDP. So that was one thing I was thinking about. Kimisha and Mark on Twitter also, well, Kimisha was saying our increased taxes. I guess that was to the argument that we had a while ago. Mark is saying the GOJ will need to increase taxes if their goals remain the same. The goals being maintained in the primary surplus targets along with spending targets, assuming that GDP doesn't increase. If GDP increases as a result of increased GDP spending, then there won't be any need for increased taxes. Even though GDP increasing, many people have mentioned it before, so I won't act like it's a novel idea, but our GDP over the past, I think it's 19 quarters now, has been anemic. It's been very low. Sub 2%. Quarterly GDP growth has been 0.x%, and GDP for this this calendar year was expected to be in and around 1%. So you can understand that within a context where the entire month of March is gone, productivity in that month is almost gone, and there is a persisted crisis and possible recession, that it would be relatively easier for Jamaica to fall in negative GDP growth territory.
Yeah, man, I think it definitely will fall into negative GDP territory, given I see Andrea, he did some calculation where he said that basically 35% of the economy, or 35% of the GDP that actually comes from tourism, and look what happened to the tourism sector. So you can expect negative figures.
Just a note for that point, that's not exactly accurate. Hotel and restaurants reflect 7% of GDP. And I had to double check this with the economist because I saw the tweet as well. So hotel and tourism represents 7% of GDP, and then that includes restaurants. So all the KFCs, the juices, whatever. So hotels, I think he says, were more about 5%. So that number is a little bit high.
Okay.
I wasn't even thinking about tourism. So guys, we have 8 minutes. We don't want, drag this out too much. I mean, me can talk the whole night. But we can cut off at 11:30. But I wasn't
reminder with the emails again, please.
Oh, yeah, man. So email us at stocksontherocksfl@gmail.com, or you can just search us on Twitter at Stocks on the Rocks. You can DM Stocks on the Rocks, and we send you all information. But what I was really talking about is not necessarily tourism, but a larger part of Jamaica's GDP, even than tourism, is remittances. So with an expected contraction in the US, so I've seen more and more articles started to say that the contraction is expected now. With an expected contraction in the US, we can expect some contraction in remittance inflows in Jamaica as well. And we can also expect contraction in other businesses as well, and services. So that is where I see our GDP being impacted, Arlan.
Yeah, I concur. So they're gonna get the hit from tourism, given it's still a sizable amount of the economy. 5% is not anything to scoff at when we're not growing above 2%. Remittance is definitely gonna be challenged, because if Americans over there are struggling right now, they don't have no money to send back here. And then the export market to the US would also be challenged if we have a fall in consumer spending.
Yeah, very, very interesting. And I saw somewhere where they had said that some possible crowding in effect may take place if the government re-enters the debt market to a large magnitude. And crowding in here, guys, means that the amount of funds that are in the financial sector, the government will start demanding or borrowing a majority of that, which would cause a natural reduction in supply to other industries. So what we're seeing happening now is that the GOJs has, over the last couple of years, the government has been pulling out from borrowing to a huge extent, and as such, there's been a lot more funds in the financial sector or in the economy to flow to other more productive purposes. So I've seen some talks of that. But final comments, guys. Final comments.
Well, for me, final comment is that everything is really, as we go forward, everything really is dependent on how we basically try to contain this virus. And the quicker we contain it, the better we can start to transition back into positive territories.
I think I just use this forum to say, practice the steps and measures that they've been encouraged us to do in terms of social distancing, essential travel alone, because we can play a part to get through this as quickly and as painlessly as possible. So that's just my little ending note.
Okay. Anybody else? I'm just seeing if there are any final questions from YouTube.
Final notes. I would just encourage everyone to do some homework because it's a necessity. Sometimes for instance, when we want to buy a car, we do research. When we want to buy a house, we do research. When we want to buy a phone, we do research. When you look at a girl or when you're dating, you do research on the person. So when you're buying a stock, you have to do research too. You can't just be buying names. There's no difference. It's the same thing. So it's just to look a little bit closer, read the newspapers, read the Wednesday newspapers, Friday newspapers, and just be more research oriented. You'll be surprised at what you can find.
Quick question. Are you guys willing, so an anonymous attendee stated, and I'm asking it in a question form, are you guys willing to continue paying 16.5% GCT until this crisis is over?
Yeah, for sure.
I mean, it hasn't, it's not in effect as yet, so we're doing it now.
We wouldn't miss it.
We wouldn't miss it because we never get it yet.
Yeah. Yeah, we never got it yet for it, so definitely would miss it.
So yeah, anonymous attendee, I think that's a good point. Well, I can say that outrightly, lowering the GCT rate wouldn't have been my first move, but you know,
Simon, you have the ministers here. You can probably
I have the
talk to him
ministers here.
about that.
Thanks for the confidence. Rahman, you have any final words?
I mean, no final words outside that. Everything that has been said before. I mean, I think what Alan said is critical. That we have to ourselves and use our own influence within our networks to encourage persons to really help to solve this problem. I mean, it's not something that we can underestimate, and that's why the financial market reaction has been so violent because of all the uncertainty. And that being said, as a country, the severity of it really will determine, how our economy or how resilient our economy is. So we just have to do the little that we can do to help.
Okay, Julie.
Just my final word is that we'll get through this. There will be another side over this coronavirus home. So look out for it and be positive towards what can happen on the other side. And there is opportunity in a crisis, but as I forget who said it a while ago, do your research if you're investing in any opportunity at all during the crisis. That's my final word.
All right. I just want to thank all the people that tuned in on YouTube, all the people that left comments on Slido, the Zoom participants, thanks panelists. Some of you have been here from 5 o'clock waiting, and some of the participants as well. It's now 11:29. Thank you so much, everybody. All right, take care and stay safe, guys.
All right.
Yeah, man, practice social distancing.
Yeah, man, we have to flatten the curve. We have to flatten the curve.
Yeah, man, and email us, stocksontherocksfl@gmail.com.
Yeah,
or visit Twitter @StocksOnTheRocks.
All right.